Greetings and good morning. Welcome to all of you here in HKMA's beautiful venue. We hope that you will pay attention to the stage and not the beautiful view outside. Thank you very much. My name is Mushtaq Kapasi. I am Chief Representative for Asia Pacific for the International Capital Market Association, and I'm very honored to be your MC for this event today. The Chinese and Asian cross-border bond markets, innovations, and opportunities. I also say good morning to the many people who have registered to view the live stream online. So thank you very much for joining as well. We have a full program for this morning, so let's get right into it. First of all, for welcome remarks, the Chief Executive of ICMA, Brian Pascoe.
Good morning, everyone. It's great, as always, to be back here in Hong Kong. As a permanent resident, I always feel very, very welcome and at home when I come back here. So great to be back, as I say. I'm Brian Pascoe, as Mushtaq mentioned, the Chief Executive of ICMA. And I'd like to extend a very warm welcome to you all for attending this launch of our fourth annual report, actually, on the Asian international bond markets, innovations, and new trends. And I would also like to express my sincere gratitude to the HKMA for their invaluable support on our research and for hosting this event, as Mushtaq mentioned, in such a fantastic forum. And personal thanks also to Daryl, as always, for his sponsorship and partnership of what we do. And finally, I'd also like to thank Bloomberg, Covalent Capital, Dealogic, Equilend, IHS Markit, and Market Access for providing the data and analysis underlying this report. So for those of you who may not be familiar with ICMA, we're a trade association focused on the fixed income security markets with offices in Zurich, London, Brussels, Paris, and here in Hong Kong. And our mission is effectively twofold: to set standards for best practice in the industry and to provide effective advocacy with key regulators and shareholders and stakeholders, rather, on behalf of our members. Some examples of the standards we have set include the Primary Market Handbook for Bond Issuance Best Practices, Secondary Market Rules and Recommendations for Bond Trading and Settlement, the Global Master Repo Agreement, which supports international repo market activity, and the Green and Social Bond Principles, and most recently, guidance on transition finance, one of the most critical themes in the ESG arena. And through our global work on market practice and regulatory policy, we play a central role in driving efficient and resilient cross-border bond markets. Now let's turn our attention specifically to Asia. As we know, over the last 2 decades, the Asian international bond market has grown significantly. In fact, from 2006 to 2021, international bond issuance expanded sixfold, from around $100 billion to over 600 billion. However, it declined to 370 billion in 2022 and has stabilized since at 377 billion in 2023, but broadly following the global market trend. The recent cycle of interest rate hikes over the past 2 years has not only increased the funding cost of G3 international bond issuance in the primary markets, but has also had an impact on international investor demand for Asian debt securities. Consequently, many issuers in Asia have turned to domestic bond markets, bank loan markets, and private debt markets to meet their funding needs during this period. One noteworthy positive trend, however, is the development of the green and sustainable bond market, which has now become a significant component of the international bond markets, both here and globally. Green and sustainable bonds accounted for approximately 21% of all annual bond issuance in Asia, nearly twice the global average of 11% last year. And similar to recent dynamics for primary market issuance, the secondary market for international bonds has also been affected by the sharp increases in interest rates, as well as concerns over inflation and geopolitical tensions. This was particularly evident in corporate bonds, emerging market bonds, and high-yielding credits, where liquidity largely dried up for a time. While higher interest rates were not unexpected, the sharp nature of the change caught the market very much off guard, and it took time for equilibrium to be restored and a more consistent two-way market to re-emerge, aided by an improving macroeconomic outlook. In terms of market structure, While there has been a growth in market electronification and the implementation of new trading protocols, such as all-to-all trading platforms, the impact of automated trading in the bond markets in Asia has yet to be fully realized. As of today, the market remains predominantly over-the-counter and voice-driven, especially during periods of market stress. Against this backdrop, we at ICMA are focused on structural and regulatory initiatives to enhance market efficiency and resilience in Asia and across the globe. These initiatives include our technical work to promote bond market liquidity and transparency, to understand the impact of accelerated settlement cycles, including the moves to T+1 in various markets, and to optimize collateral usage and efficiency. On this last point, ICMA and our membership greatly welcome the recent concrete measures by HKMA to promote renminbi collateral liquidity and to cooperate with the mainland authorities to open up cross-border fixed income markets. And I know we will hear more about this in due course. We are also closely engaged in digitalization initiatives in the bond markets, which have the potential to improve market efficiency, promote liquidity, and reduce operational risk. Notably, we are directly involved in promoting the use of distributed ledger technology in bond market issuance and securities lifecycle management, exemplified by the recent tokenized green bond offering by the HKSAR government. This issuance aligns with the ICMA bond data taxonomy, which provides a standardized and machine-readable language for key economic terms of a bond, promoting automation and reducing the risk of fragmentation across bond issuance, trading, settlement, and distribution. It marks a significant milestone to foster interoperability and facilitate scalability of distributed ledger technology-based bond markets, and is further testament to the HKSAR government's position as a leader in capital markets development. While fully scalable DLT markets are still realistically a long way off, significant progress has certainly been made. So in conclusion, although global markets in 2024 have started on a relatively strong note, we must not be complacent. A robust and integrated international bond market ultimately serves a critical role in the development of the real economy. This reinforces the role of trade associations like ICMA in bringing stakeholders together and facilitating market standards and effective advocacy that optimize market efficiency and resilience. With that said, I look forward to hearing from our expert panels who will explore these themes further. But first, we will set the stage with a presentation by the co-authors of the ICMA report, Andy Hill and Mushtaq Kapasi, who will highlight the main findings and key themes of the report. But before all of that, let me hand over to Daryl Chan, Deputy Chief Executive, HKMA, for his keynote remarks.
Brian, Mushtaq, ladies and gentlemen, a very good morning. Let me first congratulate ICMA on its successful inaugural China Bonds Market Forum in Beijing last week, and the release of the 4th edition of its Asian International Bond Markets Report. Against this backdrop, it gives me great pleasure to join industry participants today in Hong Kong to extend the conversation to cover the Chinese and Asian cross-border bond markets. The year 2023 was a fairly stable year for the Asian bond market. After a notable drop in 2022, due primarily to interest rate hikes, issuance volumes leveled in 2023 at around $380 billion. Entering 2024, with more clarity on the interest rate outlook, there's hope that issuers will gradually come back to the market. The increased supply may also help take some of the tightness out of the secondary market. That said, we should stay vigilant to the macro factors that may continue to spur market volatility. Within Asia, China continued to hold significant weight. Despite some headwinds, China still accounted for around 1/3 of the region's international issuances in 2023. In particular, dim sum bond issuances recorded another year of remarkable growth, driven by relative costs advantage in the prevailing global interest rate environment. In recent years, there's a lot of focus on the slowdown in the market, but let us not lose sight of the opportunities lying ahead. Let me highlight some recent positive developments that we believe are highly relevant to our audience today, who has been actively participating in the capital markets in this region. First is the continuing opening up of the mainland market. Just 2 weeks ago, China's National Development and Reform Commission, or NDRC, released a consultation notice on supporting the cross-border financing of high-quality enterprises. There are proposed facilitative measures that aim to streamline the offshore issuance approval and registration process for high-quality issuers that meet certain qualification criteria. Back in October last year, the HKMA and the NDRC signed an MOU to better support mainland cross-border financing activities and promote the development of Hong Kong's bond market. These are encouraging developments that reaffirm the authorities' continued support for mainland issuers to tap international markets for cross-border financing. Clearly, Hong Kong and many of you here are well positioned to seize the flows that come as the market turns. Speaking of cross-border opportunities, Hong Kong is an important gateway for international investments in the onshore bond market. Bond Connect, for example, now accounted for 2/3 of foreign investors' total turnover in the onshore China interbank bond market in 2023. Meanwhile, we're making good progress in helping bondholders to better manage their risks and liquidity. The Swap Connect, launched last year, complements the Bond Connect by facilitating global investors' management of interest rate risks arising from the allocation to mainland bonds. The HKMA is also in discussion with mainland authorities in enhancing cross-border connectivity in the repo market. In January this year, the HKMA and the People's Bank of China jointly announced the further opening up of the onshore repo market to all foreign institutional investors that already have access to the onshore bond market, including Bond Connect investors. The market consultation ended last month, and we will support the PBOC's work in taking forward this important initiative. A month ago, the HKMA started accepting certain onshore RMB bonds as eligible collateral for our RMB liquidity facility. These new measures will facilitate international investors' diverse use of their mainland bond holdings and provide them with more liquidity management tools, thereby enhancing the depth and breadth of their participation in the mainland bond market. The second development, or more accurately, longer-term trend, is the continued shift towards green and sustainable finance. Indeed, the ICMA report has covered this in length, and for good reasons. Asia's transition to a sustainable development is critical to the global climate agenda, given the region's share of global carbon emissions. Yet, the transition is challenging, given that many Asian economies lack the requisite financial resources. Encouragingly, the Asia bond market is shaping up to meet this challenge. Last year, more than 20% of the region's international bond issuances were in green and sustainable format, considerably higher than the global average of around 10%. Hong Kong is playing its part. In recent years, over 1/3 of Asia's green and sustainable bond issuances were arranged in Hong Kong. In 2023, the volumes amounted to $30 billion, equivalent to 37% of the market. Hong Kong was also the most preferred listing location for green issuances. The HKMA and the government have kept enhancing our platform to support sustainable financing activities. We appreciate that while green is on the agenda for many corporate issuers, some are concerned about the additional costs and effort for issuing in green versus conventional formats. We therefore rolled out a subsidy scheme 3 years ago, or what we call the Green and Sustainable Finance Grant Scheme, to help cover these additional costs, and more importantly, to promote transparency and accountability in the use of sustainable finance. Recently, the Financial Secretary announced to extend the scheme by another 3 more years and expand its scope to cover transition bonds and loans. We will engage the market on the details, so stay tuned. No discussions these days about the future of finance is complete without covering tech. The ICMA report highlights that digitalization has been gaining traction, particularly among Asian issuers. In 2023, there were globally more than 30 outstanding bonds that had digital exposure, whether being on a digital ledger, digital exchange, or digital clearinghouse. And Asian issuers accounted for almost half of these issuances by deal counts. In Hong Kong, we completed 2 tokenized government green bond issuances in just 1 year. The issuances have demonstrated clearly the potential of technology in enhancing the efficiency and transparency of the bond market. The most recent issuance that we did just last month was in 4 major currencies with a combined size of around $750 million, matching the benchmark sizes of many traditional issuances and attracting subscription from a wide range of global institutional investors. In this issuance, investors had the option to follow largely business as usual process through traditional market infrastructure, i.e. the central money markets unit in Hong Kong and its external linkages with Euroclear and Clearstream. This has significantly broadened the bonds investor base and enhanced its liquidity. It is fair to say that the issuance brought tokenized bonds further beyond proof of concept and towards achieving more common application. As noted by Brian just now, the recent issuance also adopted ICMA's bond data taxonomy, which is a set of machine-readable language for key bond terms and information. When widely adopted across the market, this holds the potential to facilitate the exchange of the information across parties and systems and pave the way for further automating capital markets processes. Ladies and gentlemen, a lot more is happening beyond what I have just talked about. With that, I very much look forward to the insightful sharing of our presenters and speakers in the following sessions. And one last thing before I conclude. This is an eventful week in Hong Kong, packed with summits and forums surrounding the themes of investment, family offices, sustainability, and arts. For art lovers, Art Basel, Hong Kong, and Art Central are not to be missed. So find some time out of your busy schedule to explore what this vibrant city has to offer. Thank you, Brian and ICMA once again, and I wish you a most productive event. Thank you.
Thank you so much, Mr. Chan, for the very full and insightful keynote address. From my perspective, I appreciated the notes of optimism, of course, in terms of the return of further issuance in the international bond market, but I also appreciated your remarks about the importance of official sector action and of market innovation in helping to facilitate the market as well. We can't underestimate the importance of that. So thank you again. Now, let's move on to the next part of our program. We have a presentation on the report that has just been released. By the way, you should have received an email with the link to the report in English and Chinese, but you can also look at the QR code and download it that way if you so choose. With me to present the findings of the report is my colleague, Andy Hill. ICMA's Global Head of Secondary Markets and Repo. So welcome, Andy. Okay, this will be a little bit more informal now because Andy and I are old friends by now. We've been at ICMA for more than 10 years. And what we will do is not steal the thunder from the panelists and presentations to come, but just give a very high-level overview of the findings of the report. And as you will see, this report is jam-packed with information, data, charts, insights. And I also want to give a shout out to my colleague, Alex Tsang, who was the main person at ICMA who worked very, very hard to put all this together and the lead author of the report. So thank you again, Alex. If you have any questions or further insights or comments, suggestions for future research for ICMA, we would all be very welcome to hear that. Okay, let's get right into it. So just a little bit about scope and methodology. Now we're talking about the headline numbers that we've been talking about. These are international bonds issued out of Asia. We used Dealogic data that was provided by HKMA. And the way we define this is issuers in Asia, so issuers that have their home country in Asia, issuing in the international market, so issuing cross-border, and that can be in any currency. So of course, it's mainly the G3, US dollar, yen, and euro, but also includes dim sum and CNH. And what we did in our report is we analyzed that data through many different ways, but we also supplemented it through a couple of dozen interviews with market participants who are investors, market infrastructures, intermediaries, and even issuers. So we got quite a wide range of qualitative insights as well that helped give some narrative around the numbers that we received. Now, I hope you can see this. If you can't, just tell me. But the big picture here is that the overall international bond markets, these are global numbers, did recover in 2023, but that was mainly driven by an increase in US international issuance. Asia over time, over the last few years, has consistently remained about 10% of the overall international issuance. And that has remained relatively consistent over the last couple of years. That does seem to show that there is still some room for growth in terms of Asia's cross-border issuance. The other thing that I would like to point out, and we point this out in our paper, but it's not in the chart here, is if you look at the overall issuance, both domestic and international from global issuers, if you compare the share of international issuance to the overall issuance, the percentage for Asia has consistently been less than 20%. So that means that most Asian issuance is still domestic, whereas the global number is about 35%, which means that the rest of the world, or globally, tends to be about more than a third in the international markets. So again, this to me is an opportunity for growth in the Asia market to become more internationalized. And we hope that that will continue in the future. Okay, now as both Brian and Mr. Chan have highlighted, the overall issuance from Asia from a very low base early on, 2006, 2008 was almost zero. Well, not zero, sorry. For China, it was almost zero, but for Asia, it was about 100 billion per year. That went up to more than 600 billion in 2021, which was the peak. Now it's gone down to 370, 380 billion in the last 2 years. Now, from 2022 to 2023, it's remained very stable. But what we can see there are some dynamics among countries. And basically, the main drivers of that are a slight decrease in the issuance from China and from ASEAN, and a slight increase in the issuance from Japan and from Korea. Now, what are the drivers of that? I think that our panelists will go into much more detail about that, but I think the main driver that has been cited by our interviewees is the interest rate cycle and the interest rate differential. So basically, when rates rise in the developed markets, that makes issuance internationally by Asian issuers more expensive. And it also makes investing in Asian credits relatively less attractive for international investors. So that is probably the main reason. But of course, in China, we have seen domestically in some sectors a reduction in demand from international investors, and that has potentially played a factor as well. Although there will be a slide coming up that gives a little bit more nuance to that. So stay tuned. In Japan, what has driven the increase in issuance? Well, it's mainly commercial considerations. So basically, the cost of funding for issuers in Japan has gotten better compared to domestic funding due to the yen exchange rate as well as swap rates. So it's very much a commercial consideration. Now, this is the chart I was going to talk about. This is the Bloomberg data. This is going into not just international issuance, but international investment from abroad into China. And I won't go into this too much, but I have to say, I really recommend you look at this for a while in the paper, because it's one of those charts that almost like a beautiful painting, the more you look at it, the more nuance it gives you. What you see on the yellow line is the basically the yield pickup of China versus the United States. And what you see in the green line is basically the cross-border inward investment into China, so the northbound investment. And one thing I think I can see from this is that the correlation is not that strong, actually. So in some sense, the interest rate differential has not really affected the direct inward investment into China. And also the other thing that I can see is that the investment has remained relatively flat. So what that also tells me is that the supposed retreat from China, or some of the geopolitical reasons perhaps, are maybe not as strong when it comes to direct investment into China. So I feel like this chart from Bloomberg asks more questions than it answers, and I'd be very interested to delve more deep into that.
And I was just going to make a point. When we get to the secondary section, we see something similar as well.
So I think what this goes to show is that the story is always not so simple, right? And I think it'll be really interesting to learn more about some of the dynamics here. I think one thing that could possibly explain some of this as well is that much of the inward investment coming to China is also higher grade. So I think that investment has been a bit more sticky than perhaps the lower down the credit curve. But anyway, unfortunately, we have to move on. So I'll talk a little bit about ASEAN and Korea. Basically, for ASEAN, we feel that from the interviews that the main driver for the relative decrease of this has been a shift in funding to different sources. So the funding needs in ASEAN have remained the same, but increasingly issuers have chosen to go to the domestic markets, the domestic bond markets, the domestic loan markets, and even the private credit markets, as Brian mentioned, because of relatively easier funding. And in Korea, also one of the reasons cited is a somewhat softness in the domestic credit market, which has led to more a move from issuers to the international market to get their available credit. Now, sustainable bond issuance in Asia. What we see in Asia is that the sustainable bond issuance has been relatively flat. And the interesting thing about sustainable issuance in Asia is that as a proportion of overall international bond issuance, the sustainable issuance in Asia is actually quite high. So here with sustainable issuance, China remains the largest sustainable bond issuer. Korea and Japan are also significant. Hong Kong's issuance of sustainable bonds actually doubled over 2022 to 2023. And as Daryl mentioned, even not just counting the actual issuance from Hong Kong remains the leading arrangement center for sustainable finance in Asia, sustainable bonds at least.
Can I ask a question?
Yes.
What do we think is the driver of this phenomenon?
Good question. I don't think there's one clear answer. I think there are a number of factors that come into play. So one factor that comes into play is pure demand. So I'll get into that a little bit with this chart. But if you think about international investors looking at Asian credits, so there's a subset of international investors who like emerging markets, who like Japan, who appreciate Korea, who want to invest in China, just because of the way those countries are, or because of the relative yield pickup, so on and so forth. Then you also have a separate group of investors who are interested purely in sustainability, and they're looking for sustainable bond issuance wherever they can find it. Right. So basically, this is additional investors that would be interested in investing in sustainable bonds. From an issuer's perspective, that actually has two advantages. One is it diversifies the investor base, and two, it potentially gives better pricing in the primary and secondary market because of the extra demand. Now, I think the jury is out, and I think the academic research, frankly, is inconclusive about that actual nature of that quote unquote greenium. But there certainly is perception in some sectors that that may actually appear. So there may be some pricing advantage for some issuers here. So there's the investor diversification, which I think is the main one. The better pricing, perhaps. And then the third reason, which I think is important to many, but not necessarily all sustainable issuers, is the idea that you are just becoming more sustainable. Sustainability as a corporate practice has become much more important to investors. It's become much more important to governments. It's become much more important to wider stakeholders in the ESG community and to citizens in many of these countries. So by creating a sustainable framework, by converting that into sustainable issuance, there is a sense that the company is embracing more environmentally and socially responsible practices.
Thank you.
Okay, sure, Andy. And before we conclude the primary part and get to Andy's section, I just want to highlight this slide, which I feel is very interesting. And basically what this looks at is compared to the overall issuance of international bonds from each of these jurisdictions, how much of that is sustainable? Now, I think, to be quite honest with you, we can perhaps discount a little bit Uzbekistan, Laos, and India, not because they're not important countries, but because these percentages are coming from very low issuance levels, right? In the sometimes less than $1 billion, but in the single digits, certainly. The issuance from Hong Kong and Korea is actually quite significant, though, and meaningful. So I think when you look at 54% of international bond issuance from Hong Kong is sustainable, and 34% from Korea is sustainable. 21% overall from Asia, compared to 12% globally. I think that is actually quite significant. And what that tells us is that for international issuance and for issuers trying to reach a global audience, sustainability is extremely important. And I'm sure that some of the panelists will be able to tell some of the reasons why that is the case. Now, my last slide, this is also a very interesting slide from Covalent Capital. So if you're in the room, please give yourself a shout and we'll catch up with you later. But Covalent Capital has done some interesting analysis of the investor distribution for Asia, which has actually been relatively hard to find up until recently. I'll mention two things that strike me from this data, and there are more charts in the report itself, by the way. One is that Asia actually is the majority of the investors in terms of international Asian issuance. So what that means is that unlike maybe previous years where these sorts of markets were very much perceived as US investors, European investors investing in US dollars or euro into Asia, now we're really seeing quite a lot of intra-regional investment. So this is cross-border investment, but it's within the region. And it's much more significant than I actually suspected. The second is that in terms of the mix of different types of institutions, still it remains very much asset manager, banks, and sovereigns. And at least from my personal perspective, I was slightly surprised that the numbers for hedge funds and private banks was still quite small in terms of the international investor base. Okay. With that, oops, sorry. With that, I will hand it over to Andy to talk about the secondary market data.
Thanks, Mushtaq. So to start off the secondary section, we have a chart or a couple of charts here which show secondary traded volumes. This is for international Asian corporates and financials. And you can see that there's pretty much a sharp decline from around the middle of 2022. And then it's relatively consistent throughout end of 22, 23. And this coincides quite neatly with deteriorating market conditions, i.e. wider credit spreads and particularly if you look on the second chart, higher US yields. I think quite importantly, however, is the relationship with primary issuance. And there is a very strong correlation between secondary volumes, secondary activity, and new issuance. And the two main reasons for this, one, if you look at secondary activity on an ISIN basis, you'll see that most trading activity is within the first few days, weeks, possibly months of a bond being issued. And secondly, when supply decreases, investors are more likely to hold on to positions, finding less switching opportunities. You can also see that activity in China names has also decreased as a proportion of overall secondary activity from a peak of around 70% to now less than 50%.
Sorry, Andy, let me ask you a question about that, because I know you're very technical about this, but how do you relate volumes to actual market liquidity? Does that tell the whole story? Is there more to it?
Yeah, there's a number of ways of monitoring liquidity, and it's quite difficult without extensive data. Looking at traded volumes is helpful, particularly if you then compare that with the amount of outstanding stock, and then you can look at things such as turnover ratio. But there are other factors such as bid-ask spreads. That's generally a good measure of liquidity, although that can often get conflated with volatility. So having to extrapolate for volatility makes it very, very difficult. But essentially, I mean, we define liquidity through all our work as the ability to trade a standard market size relatively quickly without changing the market or moving the market too much. And on that point, one of the first questions we ask in the interviews with our secondary community is, how is liquidity? And the feedback through 2023 has been, it's generally okay. For the investment grade segment. When we get to high yield, and we're going to look at market performance in a moment, less so, then it gets a bit tougher. But for dealing what's called social size, so up to 5 million, 10 million, even 20 million in some of the bigger names, is apparently relatively easy, and you can get two ways. And we'll look at some repo data in a moment as well. So overall, liquidity is okay.
Okay, great. Thanks, Andy.
So moving to market performance, again, we see this pattern of deteriorating market returns, both for IG and high yield, starting from pretty much the late second half of 2022. Some improvement in IG, particularly in the last quarter of 2023, which has created some optimism for 24, which we'll also talk about. High yield, however, continues to underperform. China is very much, and we saw from some of the previous data, it very much sets the tone for the secondary market and market performance. And of course, weighing heavily on the overall Asia market is China real estate. And you can see from the left-hand slide that it's really been a drag for market performance. However, and this relates to the chart Mushtaq spoke about earlier, when we go to the onshore market, we find that despite some decline, again, end of 21, 22, it's actually improved and been relatively stable. So again, we're seeing relatively good secondary market activity from overseas investors in the onshore China market. E-trading. Don't have any charts for this, unfortunately. I'd love to be able to show you the percentage of uptake of e-trading in different protocols. But one thing we are finding, and remember, this is the fourth year we've done this report, e-trading is definitely gaining traction. As mentioned earlier, it's not quite up to the same levels, we think, as the US or Europe, but definitely more appetite for using venues. Also, we're hearing more about automation, auto pricing, algorithmic pricing, RFQ remains the dominant protocol, but we're also hearing
Sorry, that's the request for quote. Right?
request for quote, which is essentially an electronified version of the market maker model. It's just a way of going to your dealer and asking for a price, but you just do it electronically. But we are getting more and more feedback that other protocols are gaining traction. All-to-all, for instance, which allows investors to reach out to a wider pool of liquidity providers. Portfolio trading. 4 years ago, nobody mentioned portfolio trading. This is where investors can trade a whole basket of bonds in one go. It's a contingent price, and it could be up to hundreds of lines. What we also find is that all-to-all and portfolio trading seem to be more popular during times of market stress. So repo, I mentioned repo. This is fundamental for secondary market liquidity provision. Again, what we hear is over the last few years, the secondary market has become deeper. More lenders have come to the market. Also, with higher rates, there's more spread, so there's more incentive to lend. Now we see, if we look at volumes, and this is based on data lend data, if we look at volumes of Asian borrow, it also seems to track the underlying market activity, which is what you'd expect. But we are hearing that it's generally deeper, and it is possible to borrow even some of the toughest names, some of the China real estate dollar bonds, for instance. I mean, they might be trading deep negative, but there is still some supply out there.
Andy, can you also comment on some of the other types of bond hedging that our investors especially talked about, such as CDS or futures? What is the role that they play in international issuance, and what is the status of those?
Yeah, that CDS comes up in pretty much every interview, and it has done for the last few years. When we compare the Asia international market with, say, Europe or the US, it's pretty limited. Basically, you have the iTraxx Asia ex Japan IG contract, and it's the only hedge in town. There's nothing for high yield.
It's basically an index.
It's an index hedge. There's no index for high yield, and very little single name activity. And this is generally a complaint by a number of participants. That said, the IG index is used extensively. In the report, we have some data from S&P that shows that certainly through 2023, it's been relatively stable in terms of liquidity provision. Spreads, bid-ask spreads are around 2 to 3 basis points. I mean, this is a lot wider than the Europe or the US equivalent, but it's been fairly constant. Similarly, in terms of liquidity provision, there's consistently around 6 or 7 dealers who make markets in the index. So it's there, but I think the market is still crying out for a more developed CDS market with single name activity. And moving to the outlook, as we saw in one of the earlier charts, market performance improved towards the last quarter of 2023, and it started pretty optimistically this year. Interviewees from a secondary perspective are hopeful that we will see more primary issuance this year, that as dollar yields head lower, we will see, and we've spoken about this already, that we will see Chinese issuers come back to the market, but also we're seeing, as highlighted, issuers from Korea, Japan, other Asian countries. There's hope that the PBOC will help to stabilize the property sector, whilst also stimulating the market or the economy. And yeah, as mentioned earlier as well, with more primary issuance, that will take some of the tightness out of the secondary market. So I think cautious optimism for 2024.
Cautious optimism. Great. Thank you so much, Andy. Really appreciate your insights and your expertise. And thanks for your contributions to our paper. Please feel free to read it. Again, we'd be very happy to hear your comments and your suggestions. Thank you very much. Now, we will move on. If you can just thank you. Now, if you'll just bear with us a moment while we reconfigure the stage, we will now move on to our first expert panel discussion of the day. I can actually use this microphone. The first panel is going to be on innovations and outlook for Asian international bond markets. We'll be talking about sustainable finance, fintech and digital bonds, global macroeconomic policy, market resilience reforms, secondary market dynamics. Speakers, first moderator, Francis Yoon, financial journalist. And our panelists are Mr. Ben Yuan, Chief Investment Officer, BOCHK Asset Management Limited, Judy Lee, partner, Climate Change and Sustainability Services from EY, Tracy Wong Harris, Managing Director and Head of Sustainable Finance Asia, Standard Chartered Bank, and Zhu, Head of Global Capital Financing Department of ICBC Asia. Speakers, you're welcome to the stage.
Good morning. Thank you for joining us today. Again, my name is Francis Yoon and I will be the moderator for the first panel of today's event to commemorate the launch of the fourth ICMA Asia Bond Study. And Mushtaq, thank you for making the introduction for us. So as mentioned, our panel title is Innovations and Outlook for Asia International Bond Markets. And as mentioned earlier, I like that key phrase, cautious optimism. I wish and feel that this might be the theme for this year. And I'm pretty sure that, although we had some headwinds in the past few years, that this might be something that some of our panelists will also talk about in terms of the exciting developments that we have with the rise of sustainable finance. And although we had some challenges with the sectorial issues in China, as well as the macroeconomic trends that continue to provide some bouts of volatility in our markets, as well as in the global financial markets, I hope and feel that a lot of the innovations for our market will continue to drive optimism. So thank you. As mentioned, Mushtaq had introduced Mr. Ben Yuan, Judy Lee, Tracy, and Mr. Ji Shu. Thank you so much for joining us. So let's talk about, or we'll start the panel to talk about the investment outlook and the bond volumes outlook for Asia. And I would like to probably start off with Mr. Ben Yuan to talk about your outlook in terms of how the market has started so far this year, and from an investor's perspective, really, what the demand dynamics have been, and just going into the rest of how the rate cycle seems to be fluctuating. The Fed funds rate might, the Fed has already talked about possibly cutting rates. With all these different dynamics going on, what is your outlook basically for 2024?
Thank you, Francis. Good morning, ladies and gentlemen. Yeah. In terms of the Asian bond market so far performance this year, as a bond portfolio manager, I can say it's a perfect, wonderful. I just look at the return,
But not just cautious, but wonderful.
Yeah, wonderful, exactly. Wonderful environment. Why I say that? If you look back, say, for the first 3 months, the US dollar Asian bond market return 1.3% up to last night. Pretty good if you look at the credit spread in this region, particularly for the US dollar Asian credit, tightened by roughly 44 basis points. 44 basis points basically offset the bumpy road of the US Treasury yield market in the past 3 months. Yeah.
So you made a lot of money.
Yeah. Yeah. Thank you. Thank you. Yeah. And the other side is because why is it wonderful? Because the market, you look at the charts, that perform quite steadily, moving up. So under the very volatile environment, as a fund manager, is very tough because we need to be proactive to deliver the message to the client. What's happening for the market? And also a lot of the clients will ask us what's happening in the market as well. Yeah. So that's why so wonderful is because we can more focusing to earn money rather to explain what happened in the market. But if you look at the dynamic, the supply side, I think previous panel already indicate very professional way to give a very clear the trend overall. Say in 2021, the international Asian bond market, the new issuance size around 610 billion US dollar, but last year is only around 30 billion US dollar. So in that sense, as the investors, we don't want to see less selection from us in this market. Yeah, definitely. Yeah. But if you look at on the other side, say for the dynamic for the demand side in the international Asian bond market, so far this year is very good. If you look at like different ways to measure, first is measure for the credit spread. Of course, credit spread of the market reflect different types of factors, right? Including for the outlook of the credit trend by the investors, and also in terms of the supply side of the issuance market, and also say a lot of the demand, how the investors put their money into different types of the sectors. Yeah. So far this year, this demand side we can see if you look at measuring for the new subscription over subscription for the international credit market, we normally talk about easily 5 to 6 times. Yeah, for the new issues. So that represents the market demand is very strong for the international Asian bond market. Yeah. On the challenging thing in this market, I would say we haven't talked about in previous panel belong to the long maturity demand on the Asian international bond market. I think it's a really high demand backed by the LIFA, the insurance company, because in order to matching for the liability, they need to invest in a longer maturity. So I think one of the things I, as an investor, we would like to see if more long maturity issuance from the international Asian issuer, that will be really great news for the investor in this region. Yeah.
Oh, that's interesting. Just wanted to quickly zone in on the spread compression that you mentioned earlier. Can you talk about why that's happening? I mean, is it really a factor of, you know, the idea that there could be less supply, or is it because the risk appetite is improving, or maybe the outlook for the rate cycle internationally is also playing a factor?
Yeah, one big direction is belong to those as talk about for the bumpy roads for the U.S. Treasury market in the first 3 months around the world at the moment. But it's quite consensus view. We talk about interest rate cut this year, not only in U.S. but across a lot of the other Asian countries, etc. as well. So in that sense, make for the as I mentioned, for the bond as an asset class in terms of the demand increase quite substantially. So that is one of the very high demand for driving for the credit spread tightening. And second thing is if you look at say for the underlying economy in this region, also very stable as well. And also we expect some more stimulative policy introduced by the government in the region, no matter for the monetary policy or fiscal policy, in order to supporting for the economy, etc. So this type of the thing supporting for the credit spread in a very nice keep tightening as well. And the last thing is a bit bad thing belong to the investor with less selection from the reducing size of the Asian bond market. But flip the coin on the other side, that belong to the technical factor supporting for the Asian credit spread tightening.
Let's talk about China. This is the most critical part of this regional bond market. And basically, when we look at the issuance from last year, there is a decline in the amount of bonds that Chinese issuers are issuing in the international bond markets, as a factor of the divergence in monetary policies between the US and China and making the onshore funding rate more attractive. We want to know Chinese issuers are thinking for this year. And Jishu, this is your expertise. I mean, you speak to a lot of Chinese issuers about their views on the issuance environment and the backdrop. I mean, it's the million-dollar question. Will we have more Chinese issuers come to the market to sell international bonds? What is your take on that? And yeah, I'll ask you that question first before I have another follow-up.
Thank you, Francis. And firstly, I would like to say that maybe last year is a wonderful year for bond, but for issuer, they are still a little bit suffer. Okay, but as Darren mentioned, several minutes ago, that we believe that this year some China issuer will come back. Okay, because in this year we can say that roughly more than 140 billion US dollar will mature, and next year still a big amount will mature. So a lot of issuers still have to consider how to refinance, and I believe that the logic last year is that a lot of Chinese issuers use bridge loan to refinance their mature bonds and use such as the US dollar bridge loan and the CNH bridge loan, but they found that the bridge loan cost is still very high. Sometimes it's higher than the fixed income debt. So that means a lot of issuers consider to start to monitor the windows and monitor the yield treasury to start to prepare the issue fixed income bond again. And but we have to say that the different sector have different performers. Firstly, the financial sector, for example, banks, they're normal. No change. They still have a big amount of insurance in the market and account a big ratio in the total size. And but for the real estate, it decreased a lot, and it's difficult for them to issue again. And we still see the policy change. And for the local government financial vehicles, we see that in the first quarter they issue account roughly half of the total amount insurance, but we still monitor whether it is still windows for them and whether it change some policies in the future times. So what I say is that some SOE is preparing, and but as I said, they are still looking for the windows. And but what I say is that Ben could be very keen for the issuers again, and we also told the issuers that Ben is waiting for them.
On that note, can you talk a little bit more about, because you probably have a lot of discussions about their views of the market. I mean, do they think that this market will be, this year would be more conducive for issuance because of the possibility that the rate hiking cycle could ease in the US, for example. And, as Ben mentioned, there's still a lot of demand for these types of issues. I mean, that hasn't really, deteriorated. It's actually strengthened because of, these really positive technical factors. I mean, can you just talk more about what are these Chinese issuers looking to in terms of what considerations are they making when they look at the market right now? Are they optimistic that maybe the interest rate cycle could be easing and that could be more conducive for them?
One of the key consideration for some Chinese issuers is that the difference between the US Treasury and the China Treasury, because right now it's that in the China onshore loan market, the banks competition is totally rough, totally tight. So you can see a lot of long year and long term and very low rates right now for the onshore loan market. So they have to prepare the loan product, the bond product, onshore, offshore, and US dollar or CNY. So they compare a lot of factors, and then they find the good windows to make the right decision. So that means they have a lot of choice. So whether they should issue a US dollar bond or CNH bond, could compare a lot of reasons, but the price would be a key factor. So this is what I monitored.
Okay, and then just lastly, Ben mentioned that there's a lack of, longer duration bonds, and there's a very high demand for that. Do you think that we'll see maybe an uptick in that part of the market from China, possibly?
Yes, possible. Yes, possible. And I think if the what I saw is that whatever the SOEs or whatever the good rating banks, when they issue this year, when they issue in the public market, and they will receive a lot of orders this year. So I think the market right now is good. The function is very good. The investors and the issuers are very good, but the price is still waiting for.
Okay, great. Then just quickly wanted to ask you about the secondary market. I mean, we talked about how there's been quite a bit of spread compression, and then there's also quite a bit of demand, but there's sort of some challenges in terms of liquidity and so forth, and the availability of bonds. I mean, can you talk more about what the environment looks like right now, where are the challenges, and how are you guys overcoming it as an investor?
Yeah, I think the previous panels already indicates in terms of trading volume reduced a bit compared with in the past. So that's one of the challenging point for us as the bond fund managers to do some of the switching. We would like to sell some bond, but it's quite difficult to buy the other suitable bond back to our portfolio. So that's one of the challenging point. The other type of the observation I would say quite interesting. Say particular ESG, this big topic very familiar in the past few years, and so also we observe a lot of the investor, including fund manager, including for the live investors, and including for the bank investor as well. They are more and more focusing for the ESG topic. Yeah, particular for selecting for the bond, like for example, investing more for the ESG bond, green bond, sustainable bonds, etc., etc. But the other interesting point is in terms of the industrial sector, some industrial sector more demanding by the bond investor as well. Like for example, renewable type of the sector. We can see if we look at the new issues in the market. Well, I talk about, normally for the normal issues been 5 to 6 times oversubscription, but for the renewable bonds are easily to be oversubscription by 10 times, etc., etc. So that type of and make the primary issuance credit spread in the most tight level in that sense. So back to the point, say the observation of the investor demand on the ESG topic actually changed the environment of the market as well, I can say.
Thank you for talking about that topic, because that's a perfect segue into the next theme that we want to talk about. And a very exciting development is sustainability in Asia. It was also pretty impressive to see how much of that issuance globally comes from Asia, and how much Hong Kong is spearing that as well. We have 2 sustainability experts on our panel today, and I wanted to first ask both of you if you can talk about your outlook for sustainability. What are some of the major developments we've seen in terms of what's been impacting sustainability in Asia? What are the major regulatory announcements or developments? Yes, Tracy or Judy, if you want to take that first.
Sure. Thanks, Francis and Daryl and Brian, and ladies and gentlemen in the room and online. Good day to you all, and delighted to be here sharing this topic, passion to my heart, and thanks for HKMA and ICMA hosting it. So, wow, this is a lot of your questions come with a lot of sub questions. So let me start with the market trend, and I think looking at the earlier panel from Mustache and also from Andy share, the overall green or sustainability supply is a function of the overall market. So as the recent trend that we have highlighted in the earlier panel from the China real estate market and the overall market size, has tapered. So I think this has impact on the overall ESG issue in that market. But the good thing and also positive trend came out of it also from the earlier panel is the overall penetration in the ESG space per se is higher in Asia than globally. So I think this is a point that I think will be continue and hoping to continue in this side as well. And then if I look at global and Asia in 2023 on the back of the macro trend, it was slightly reduced by about 10, 11, 12% overall. And green bond is still the biggest contributor, over 50%, both in Asia and globally in the overall market. And another phenomenon beyond that is looking at the sustainability linked product, in particular in sustainability linked loan. So if I look back to the last 5 years, this is actually one of the fastest growing of the last 5 years. However, last year, the volume halved on the back of a UK regulators comments on concerning of the market's integrity. So for that note, it's really tempered the market a lot. I'm happy to delve a little bit more in that topic. And another observations of the trend is we've seen the social bonds or the social issuance have picked up on the back of COVID, and especially even in last year. So on the social bond space, we have seen it growth double in Asia last year, 2023. So I think these are sort of the key trend associated with it. Happy to come back on the regulators, but let's pass to Judy. Oh, thank you. Sharing the China color.
Yeah, thank you. Good morning, everybody. So thank you for invitation from SMA and the host from Hong Kong MA. My name is Judy. So very pleased to be here today with all of you. So let me echo what Tracy just mentioned. And I would say that we hope every year is a wonderful year. Yeah. So for Chinese issuers, by end of 2023, there were total over 3.6 trillion RMB yuan issued both on onshore and offshore markets in terms of a green bond. But we can see there are some characters in 2023's issuance. So number one, there was a new innovative bonds, for instance, like a carbon neutrality bond, so which was encouraged to use proceeds on CO2 emission reduction projects. And number two, there was some, blue bond, so to protect the ocean and also to encourage the ocean economic growth. And also there are more and more issuers, they are targeting on sustainability linked bond. So how to link the ESG performance with the economic growth of the companies. So these are some new characters for Chinese issuers for both onshore and offshore markets. That's one thing. And second thing is that, the China and the EU, they set up a CGT, Common Grant Taxonomy, so which is a combination of green categories between China and EU. So EY as one of the expert group to certify the Chinese bonds, which are in line with the CGT. So by the end of January 31st, 2024, we already confirmed over 260 bonds issued in China market, which is also in line with the CGT. So I think that more and more Chinese issuers, they would like to adopt international standard, even when they issue the bonds in China. So that's a good showing that Chinese issuers are very keen to attract international investors to focus on Chinese bond markets. So that's the second thing. And the third thing is that I think the Chinese government, we talk about the policy. So the Chinese government, they are pushing the sustainability disclosure. So I think most of you already noticed that in February, so CSRC, Chinese Stock Exchange Regulation Committee announced the sustainability report guideline for Beijing, Shanghai, and Shenzhen Stock Exchange. So among the over 5,000 Asia listed companies, there are minimum 465 companies are required to disclose the sustainability report starting from 2025. And also the indicators of sustainability report a little bit higher required for the Asia. For instance, like in this guideline, the regulators require the companies to disclose the ESG KPIs, which include pollution prevention, ecological utilization, carbon neutrality target setting, and development in rural areas, and also other social impacts. So this is something quite new for the companies listed in Asia. So these things that are also a good show for the Asia companies to further enhance their ESG management, and also will be good for the green bond sustainability bond issuance in the future.
So Judy, how are you, I mean, this is, you probably have a lot of work to do now because of all of these new, positive measures. Can you talk about like what kind of work you're doing with the Chinese clients now and with the regulators? I mean, do you have to basically, walk them through everything in terms of explaining what the disclosures mean and how to do them? If you can just provide more detail on how you're working on that.
Yeah, that's a very good question. We back to 10 years ago, say 2015, that was the year that we established the first workshop with SMA in Beijing for the green bond. So at that time, most of issuers, most of the listed companies in China, they didn't know about ESG. They knew nothing about green bond. But now in 2024, most of our clients, they are not only targeting on ESG reporting, they are saying how to establish the ESG strategic plan for the future, how to avoid ESG potential risks, how to do more investment in terms of a ESG improvement, and how to set up a ESG IT system to collect the data automatically. So this is a big change in China market, and more Chinese issuers, they are trying to diversify the bond types. So as I just mentioned, the green bond, blue bond, transition bond, carbon neutrality bond, they were trying to innovate the new types of ESG investment. So this is something we have been working very closely with our clients in China. And, more and more Chinese clients, they are trying to go abroad to invest in Belt and Road, and also to collaborate with different companies in Asia, in other countries in Europe, and as well as in US. So that's a good chance that, Chinese companies, they are trying to build up ESG as a very good management tool as part of the corporate governance. So that's something I think quite different.
Yeah, if I may add on, making a few comments back on Judy as well. I think on highlighting on the significance of the common ground taxonomy. So beyond bond on the China, over now to 160 China bond issuer that's aligned of the common ground taxonomy. We have also seen in the loan market that we have onshore, offshore. We have been helping clients to issue syndication loan that is the common ground taxonomy in line. And why is this significant? I think this helped to facilitate the interoperability also from the Hong Kong MA development on the green taxonomy, as using that common ground taxonomy as a base. That interoperability really helped the market transactions. So that's one. And secondly, going back to the regulator comments, I don't want to leave with such a negative news on the SLL markets, right? So I think legitimately, so it was a positive market movement to highlight the tightening necessary, like the integrity, how you assess the key performance indicator, how the target setting is being ambitious. I think it's rightly so to put a spotlight. But I think looking at that, how the market has moving on, and the product, take a step back about the product itself. So moving away from the, use of proceeds of bond or debt instruments, having this linked structure, sustainability linked structure, actually has a higher transparency of demonstrating what the borrower required to deliver over the terms of the borrowing time. So it's actually the tool, the product itself is actually more transparent by product design. However, how execution is where the key is, right? How this product is being executed. So after the announcement, I think the ICMA already have the revised sustainability linked principle came out and actually addressed quite a number of this issue already. And I feel that, you know, with decarbonization, net zero as a core topic still driving the momentum in the whole sustainability space, this will remain to be a core important tool, but it's down to the executions of all that, and with the principles being tightened and revised. And also looking at Hong Kong, I think Daryl mentioned the grant scheme. Having that, you know, the Green and Sustainable Finance grant scheme and further to expand to transition financing. And this grant scheme helped the issuer to, you know, when they consider to issue the either bond or loan, they will think about, okay, second party opinion. And that's push up the standard and also adherent to the SLLP principle that the external, the SPT, the performance target need to be externally validated, and these are covered by the grant. So this help the, you know, the market to be a more, move to a higher standard with a second party opinion. It's just like credit rating. All your bonds, you require the credit rating. And for the public issuance in ESG sustainability space, having that second party opinion and that external validated data on the link structure, I think that will help to address some of these key concerns.
I mean, when you listen to these types of developments, I don't doubt that, you know, the market, especially in China, is moving in the right direction. And as we saw in some of the slides earlier, the, you know, increasing interest and demand in onshore China bonds. I mean, this is also going to really help foreign investors look onshore to invest in these types of ESG sustainability bonds. But that sector of the market is also probably facilitated by, you know, what we call like safer issuers, like banks, for example. What about in terms of the types of issuers that have more of a GHG footprint and needs to consider transition finance, for example? Maybe the two ladies would like to talk about, you know, transition finance in terms of where we need to see more progress. I mean, if we've seen anything very substantial in the past few years or a few years, and in terms of like, you know, talking to the Chinese issuers who have these issues, the demand for financing is very high, according to G, and we need to know like what more can we be doing to help these types of issuers also get access to much needed financing. I mean, these are the areas where we really need to see improvement to increase the carbon footprint and, you know, hit those targets for China, for example.
I think we definitely need another panel to talk about transition financing, but let's kickstart. I think absolutely. I think the demand is there, but I think we have to be also, I want to be very clear about when we talk about transition financing, what does it mean? So absolutely important to get to net zero, carbon neutrality, decarbonize. But with that, on the strict labeling, what I mentioned about sustainability linked product actually is a good demonstration of moving towards an industry or a company towards transition. However, when we talk about transition finance labeling, and that is where the tricky part. So it's very strict and very nascent at the moment. So transition finance apply to high carbon intensive industry on what activities and what asset you can deploy it to. And with that, maybe I take Standard Chartered, how we look at this and how we approach as an example. So as a bank, we alongside with my peer bank, our biggest carbon emissions is actually our scope 3, our portfolio, our finance emissions. So over 90% of our carbon emissions to be in our finance emissions. And with that, Standard Chartered, we committed to net zero by 2050 for our finance emissions. And how do we approach that? So we look at our overall portfolio by industry. So we broke it down to 12 industry, and we have set interim targets by 2030, how our portfolio, you know, may that be in, you know, power sector, metal mining, you know, oil and gas, and all these high carbon intensive sector by 2030, where we need to be. So that is how we are tracking ourselves on the net zero pathway. But then it's no good. Well, it's very good to start with measuring it, tracking it, and telling our investor, the market, where we are. But the end of the day, all my clients need to be net zero in order for us for our portfolio to get to net zero. So how do we do about that? And this is where the transition finance strictly label that come in, because there are capital we can't deploy in a green or linked format on this high carbon intensive industry. So we need to deploy in a transition finance label way. So for that, we have published our own transition finance framework that lists out all the qualified transition activity and asset that we can do. And addition, beyond just listing out the asset in taxonomy format, we have our own assessment. Look at the borrower. What is their transition plan? Do you have a public commitment? Do you have a viable business plan to facilitate your transition? And do you have even if whether that technology or activity that is viable as part of that industry transition. So it's kind of both ways. Doing that assessment on the borrower or the company or client's perspective and that qualified asset in the taxonomy way, in a more transparent way that we actually publish that to the market. So when we say this is a Standard Chartered issue transition finance label transaction, it's very transparent that you can go back to our framework to look at that. That's one. And then secondly is on, there is a big gap on capacity and capability from our client set as well. So how do you facilitate, like Judy mentions, and how the firm help client and making that step and processes. So for us in the bank, we also have set up a transition accelerating squad. These are industry experts on specialized in this high carbon industry to talk to the client and look at their plan and opportunities. And also ESG advisory on disclosure reporting, because that's the necessary starting point on backing up what is readiness of where you are on disclosure reporting. I think that go back to one of the your comments make on that point on ISSB requirement coming to the market in China, Judy mentioned, and also Hong Kong is coming along as well. Last but not least, and having that, we also have my team, sustainable finance origination in the core market to help the client to do the sustainable finance execution transaction. So I think this is where like a multiple prong approach from a bank perspective, how we look at our transition pathway, and then how we come up with a clear, transparent framework and technical support to work with our client with their transition.
Right. Judy has experience with working closely with the industry, for example, on this topic. Can you talk more about where the progress is going? And after that, because we're starting to run out of time, I need to ask Ji about the transition conversations you're having with Chinese issuers as well.
Yeah, sure. I think the biggest challenge for transition finance in China is how to define the transition projects, especially for banks. So how to select those projects with transitional benefits. So that's why we supported different regulators, at the central level and local level, to establish the standard for transition in different industry. For instance, I was very honored to join PBOC's expert group to establish the transition finance standard. And also, if you check that last year, Huzhou in Zhejiang province and Hebei province, they just announced their transition standard. For Hebei province, they published this transition standard for iron steel industry specifically, because iron steel companies in Hebei province, they generate a huge of a CO2 emission. However, they need financial support to do the transition. So that's how we support the Hebei province to establish a standard for iron steel industry. And after that, Bank of China issued a transition bond in November 2023 in offshore market. The proceeds was mainly used to support the iron steel companies in Hebei province to do the transition. So I think that's a very good example. Number one, to establish standard. Number two, use financial support to, to accelerate the transition in local province. That's a very good example. And early this year, NDRC just updated their green category. So previously, they published the green industry category. In the early this year, they upgraded to green and low carbon industry category, so which included transition projects. So that's how we believe that in the future, there will be more and more banks and issuers and financial institutions to support the transition projects. Thank you.
Gee, can you talk about the conversation in terms of transition finance for Chinese issuers?
Very quickly update that yesterday I see the report that NDRC just announced that they will push equipment renew program in China in 7 industries. The total amount could be 5 trillion CNH. Okay, and every year to achieve the core or copy and the core neutral, that they estimate that every year the companies will investment 2 trillion CNH every year. So that means in this program, in this estimations, that a lot of I believe a lot of investment should be categorized in the transaction finance. So what I think is that the demand for the transition finance could be huge and a very potential growth in the future. So what I mean is that right now the green financing, the SLA bond, such as this products right now is very standard, but transition products right now they don't have the standard products. But I think that Julie and Tracy already mentioned that some difficulties. I don't like to repeat again. What I think is that the transition finance still an opportunity for all of us in Hong Kong, because that if we move forward, we set up the good product, we design good product, and we can also attract the Chinese issuers and of course the other issuers in the world. They also have this demand. So this is what I would like to add.
It's great that even on the investor side, there's very large demand, as Ben mentioned, where, some of these ESG related bonds in secondary markets, for example, there's a lot of demand and there's oversubscription rates even in the primary markets. There are some challenges though from an investor perspective that I wanted to ask Ben, because when it comes to things like the climate risk in portfolios, for example, there might be some fluctuations as, the types of issuers start to shift from, just the financial institutions to more of the actual, corporate issuers or, those that have like high emitting numbers. I mean, can you talk more about what it's like what are some of the challenges that you face as this market continues to develop?
Yeah, sure. Yeah, thanks. Yeah, let me maybe step back a bit. Basically for the asset managers in the past few years, we are more conscious and focused for the ESG and climate risk, that type of the topic. According to different types of the dynamic developing very fast. One is like, for example, for the asset manager in Hong Kong, we need to discuss some of the carbon footprint for our portfolios, subject to the climate risk type of the information, etc. And like Judy and Tracy talked about, say, also the regulator, to indicate for the issuer to disclose a more higher level of the ESG type of the information to public and also to the investor as well. So this is a very good framework in order to give the asset manager has a higher chance to tackle the issue by using a more higher level of the information. And also the second point I would say for the asset owner, in the past few years, they also changed a bit as well. Like, for example, they request or a higher asset manager, they will send out the RFP, request for proposal. In the past, they never asked for the ESG type of the question. But now 100% of the asset owner, they send out the RFP, the definitely will ask the question related to the ESG, how the asset managers, install the ESG consideration factor into the investment process, etc. So that is another dynamic, forcing for the asset manager has to consider more about for the ESG type of area. And also, last thing is belong to the a lot of the ESG data provider, because we keep on going to discuss with the ESG data provider in the past few years. We observed that, let's say 4 years or 5 years ago, we talked with them. A lot of the ESG data provider, they haven't really ready and complete the database yet. But if we talk about, say, the latest update, I think most of the, the global type of the ESG data provider already in a very good established for the database, no matter measuring for the physical risk, the transition risk, for the climate risk type particular area. So as a manager, we can more easily to hire this type of the ESG data provider and the platform helping us to measuring our portfolio, particular to do our scenario analysis, how the impact of the physical risk and the transaction risk, etc., etc. So what I'm talking about in here, because the market environment changing quite substantially, and also a lot of the different type of supporting for the asset managers to consider this type of ESG factor built in the portfolio. So back to the point, how we adopt this type of the different type of information apply into our portfolio investment for a particular considering ESG. I think different type of approach we can do. One of the most easy way of the approach to do is to buy the ESG bond, the green bond, sustainable bond. This is the most easy way for the manager in order to enhance the portfolio, the component of the ESG standard in that way. The other type of the, for the way to enhance for the ESG component in that direction belong to some of the, the screening process. We can screen out some of the so-called bond industrial type of the sector we don't invest into. But back to the point, say, if you look around in the global, we don't have the, standardized definition of the bond industrial. So that is the other type of the headache. If you screen out in so-called bond industrial, we have to be very careful. And the third way we can do belong to, as I mentioned, say, we can, for example, set some of the carbon footprint for our portfolio. Looking forward, say, in each year, we target, to reduce the carbon footprint in our portfolio. In that way, belong to, put it the direction for our PM to achieve that way. But of course, in order to do this type of the carbon footprint type of the measurement, for the implementation point of view, we have to be very carefully, because one is we can't overpromise what we can do. This is very dangerous in terms of the greenwashing, whatever that type of the topic. But on the other hand, for example, when as we understand, like financial sector, the carbon footprint lower than, let's say, some mining sector, right? So if we also understand, say, different types of the sectors according to different type of market environment, as the managers, they will overweight, underweight. Let's say, for example, this year we are more overweight for the financial sector and much more underweight for the mining sector. But because of the environment change, the mining sector type of the opportunity higher. In that way, if we force down the financial sector's over position in the portfolio and increase a bit of the mining sector, in that sense, it will increase a certain degree of the carbon footprint in the portfolio. So this is one of the example. As a manager, we have to be very careful in order to how to manage for the carbon footprint. That's one of the example. And the other type of the challenging thing is belong to the ESG topic. I think is new for everyone. Like for my generation, when I studied university, never touch what is that ESG, right? So for our some of the senior PM as well, portfolio manager, in the past they they didn't learn about for the ESG. So that is the one of the thing we need to to hire or also to invite some specialists like Judy Tracy to educate our PM what is this type of the ESG topic in that sense. Yeah. So this is another challenging way for the asset manager in order to educate for the PM to adopt for the the ESG investment process in our portfolio management. Yeah. And yeah, so that is what happening. Yeah.
Great. I think we have to wrap up the panel, but I wanted to thank our panelists for spending your valuable time talking about some of the most exciting innovations and developments in the Asia bond market. As you may also notice that Tracy and Judy are wearing blue and green to kind of lift up, to represent, the drive for green innovation going forward. We didn't get to talk a lot about the digital bond developments, unfortunately, but we're basically in a city where the innovation is really becoming, driving forward, and Hong Kong is really, playing that part in international finance in Asia here. So thank you so much, HKMA, ICMA, and our panelists for today. Thank you.
Thank you so much. Actually, could we ask the panelists to stay on the stage for a picture, please? Sorry, thank you. And to all of those in the audience, thank you very much for your attention, your patience, and your interest. We will now have a coffee break with refreshments just outside in the venue. We're running a little bit behind schedule, but we'd like to give you time to get to know each other and have some great conversations. So we will reconvene here at 11:10. That is 10 minutes after 11 o'clock. Please come back for some very interesting presentations by HKMA, by CCDC, and our second panel of the day on China cross-border markets. Thank you very much. Please come back at 11:10 to continue. Hello, everyone. Could we please ask you to make your way to your seats now? Thank you. Hello again. Could we please request all delegates to return to the venue and to your seats? We will continue the conference momentarily. Thank you. Hello, everyone, and welcome back to the conference. Thank you very much, and hope you enjoyed the networking and the refreshments outside. Now, we'd like to continue with another keynote presentation, Hong Kong as a premier regional bond hub. We have as our speaker Daniel Leong, Division Head of the External Department of the Hong Kong Monetary Authority. Mr. Leong, welcome to the podium. Thank you.
Hi, ladies and gentlemen. Thanks for having me here to deliver this presentation. I'll get rid of myself first. The Title of my presentation is Hong Kong being a premier regional bond hub. And I think we all agree that Hong Kong is a major bond hub in Asia. We have been the preferred location for arranging bond issuances for issuers in the Asia region, thanks to our deep and liquid capital markets, our broad issuer and investor base, and our rich ecosystem of service providers, such as arranging banks, legal advisors that provide a full-fledged support to the bond issuance processes. Last year, we captured around a quarter of all international issuances from Asia, equivalent to almost $90 billion. This figure was slightly lower than the previous year, mainly due to the reduced mainland offshore issuance in 2023. In 2022, we captured close to 1/3 of the market and topped the chart for the 7 consecutive years. Last year, we also captured 78% of debut issuances in the region. These issuers added to the new impetus to the growth of our market. The strength of Hong Kong in sustainable finance is also evident, with $30 billion of green and sustainable bonds arranged in Hong Kong last year. And we continue to be the number one hub, capturing over 1/3 of the regional market. Against this backdrop, I would like to focus on 2 major areas of development during the past years, which have been under the spotlight, attracting a lot of attention from the capital market, which is mainland connectivities and technology. As we all agree, Hong Kong's role as the dominant gateway to China is facilitated by our ever-growing suites of Connect schemes, which has provided unparalleled access to the onshore financial markets. Since the launch of the Shanghai-Hong Kong Stock Connect in 2014, which enabled global investors to allocate to A shares in a convenient manner via the Hong Kong Stock Exchange, we have continued to expand our suites of Connect schemes to mainland markets, including the bond markets, ETF, and derivatives markets. These include the launch of the Shenzhen Hong Kong Stock Exchange Stock Connect in 2016, Bond Connect in 2017, and the inclusion of ETFs in the Stock Connect in 2022. Of course, with the launch of the northbound trade of Swap Connect in 2023. In January this year, the HKMA and the PBOC announced 2 important initiatives, which could create synergy with the Connect schemes to provide global investors with more channels for liquidity management. The first one is the further opening up of the onshore repo markets to all CIBM foreign investors, institutional investors, including Bond Connect investors. And the second one is the expansion of the list of eligible collaterals for the HKMA's RMB liquidity facilities to include eligible onshore RMB bonds. This marks the first time onshore bonds are being formally recognized as eligible collaterals in the offshore market. With continuous expansions and refinements, the Connect schemes have become the major channel for portfolio investment flows into mainland China. As of now, more than 70% of foreign holdings in onshore equities are held through Stock Connect, and around 1/3, 2/3 of foreign turnovers in the CIBM markets are traded through Bond Connect. Since its launch in 2017, Bond Connect has received positive feedback from the market and continues to be welcomed by market participants. As of end last year, northbound Bond Connect has onboarded more than 800 institutional investors, and the average daily turnover has increased by more than 17 times since it's launched. The unique attributes of Bond Connect are key to the success of the scheme. Riding on Bond Connect, foreign investors can gain access to the onshore bond market using their existing presence in Hong Kong, as well as following international rules and market practices. Investors are not required to open onshore accounts, engage onshore agents, or sign documentations or contracts governed by non-international laws. Investors can also leverage their well-established relationships with trusted global financial intermediaries, trading and settlements supported by financial infrastructures and service providers in Hong Kong, will follow international regulatory standards and market practices. To complement Bond Connect, Hong Kong also offers an expanding range of tools to address investors' relevant needs as they increase their allocations to onshore bonds. For risk management, the launch of the northbound trading of Swap Connect last year has established a convenient and secure channel for international investors to trade interest rate swap products on the mainland via connections between infrastructure institutions on the mainland and in Hong Kong. Furthermore, offshore treasury bonds futures will be launched in Hong Kong soon. These tools will facilitate global investors' management of interest rate risk arising from their onshore bond allocation. For liquidity management, the opening up of the onshore repo market and more use cases of onshore bonds as collateral in the international markets will address international investors' growing needs for funding and liquidity management as they increase their allocation to onshore bond markets. Starting from February this year, the HKMA's RMB liquidity facilities will accept onshore CGB and policy bank bonds as eligible collaterals. As mentioned earlier, this marks the first time mainland bonds are formally recognized as eligible collaterals in the offshore markets. These initiatives and the potential extensions to other use cases of onshore bonds being collaterals in the offshore markets will facilitate the diverse use of mainland bonds held by Bond Connect investors to address their needs. Moreover, the gradual opening up of the onshore repo market will address offshore market players' growing needs for funding and liquidity needs. As an expansion to the current arrangements where only sovereign entities and offshore RMB clearing and participating banks under the CIBM direct routes are eligible, this initiative will, for the first time, enable more foreign investors, including Bond Connect investors, to conduct onshore repo transactions to obtain liquidity. These measures definitely help to create a more comprehensive ecosystem and seamless investment experience for investors accessing the onshore markets via Bond Connect and could further encourage participation in the Bond Connect schemes. Now let's turn to the second bright spot, which is technology. Over the past decades, the accelerating technological innovation has sparked new opportunities to transform and rethink financial market structures and processes. Distributed ledger technology, or DLT, for example, has gathered various use cases in traditional capital market products and services and processes, such as bond issuance, investment, and trading, given its potential to generate efficiency gain, reduce costs, and enhance transparency, as well as to facilitate investors' participation. According to the ICMA, last year, there were more than 40 technology solutions globally available to automate all or part of the debt securities issuance process. And over 30 outstanding bonds that had digital exposures, such as issued on a digital ledger, digital exchange, digital clearinghouse, or a combination of these. Technology adoptions in this part of the world is also gaining momentum. 28 of these technology solutions were available to Asian bond market participants, and Asian issuers accounted for almost half of the 35 outstanding bonds that had digital exposures. For Hong Kong being an IFC and a major bond hub, we see a lot of potential in embracing innovation and exploring the adoption of relevant technologies. This is exactly what prompted the HKMA to embark on the tokenization journey in 2021 with Project Genesis in collaboration with the Bank for International Settlement Innovation Hub Hong Kong Center, which successfully concept tested the issuance of tokenized green bonds in Hong Kong. This project has laid a solid foundation for our subsequent breakthroughs. Building on Project Genesis, we took the initiative beyond proof of concept to actual real money transactions and have successfully executed 2 tokenized green bonds issuances for the HKSAR government last year. In February last year, we conducted the world first issuance of tokenized government green bonds. This landmark real money transactions of 800 million Hong Kong dollar prove that Hong Kong can provide a flexible and favorable legal and regulatory environment for tokenized bond issuance. 1 year after the issuance, we have successfully applied DLT to complete the full bond life cycle, from primary issuance to coupon distribution, secondary trading settlement, and maturity redemption. We summarize the experience of the first tokenized issuance in a report that we published in August last year. The report is named Bond Tokenization of Hong Kong. This report outlined the key options and considerations for a tokenized bond issuance, from technology, deal structuring, to legal and regulatory aspects. We hope that this can serve as a blueprint to guide market participants that are interested in conducting similar issuances in Hong Kong. Building on this success and previous projects, we continue to try to push the boundaries and break new grounds. Last month, we conducted a second tokenized issuance. This time, we managed to issue in 4 major currencies: Hong Kong dollar, RMB, US dollar, and euro, marking the world's first multi-currency digital bond. The sizes of many conventional, the aggregate size amounted to around 6 billion Hong Kong dollar, matching the benchmark sizes of many conventional issuances. The issuance attracted subscriptions by a wide spectrum of global investors, ranging from asset managers, banks, insurance companies, private banks, and non-financial institutions. Centered to the success of this second issuance was a groundbreaking investor access model that helped overcome participation hurdles in their typical tokenized bonds. Investors had the options to access the bond via existing market infrastructure, i.e. the Central Money Markets Unit, CMU, and its existing linkages to Euroclear and Clearstream, using largely business-as-usual practices. This helped broaden the bond's investor base and enhance liquidity, adding scalability to tokenized bonds as a product. We also adopted machine-readable language developed by the ICMA, i.e. the bond data taxonomy. If adopted more widely across the market, this could well pave way for promoting processes automation and cross-system of interoperability, which is again key to the scalability of tokenized green bond market. Overall, our 2 tokenized issuances have demonstrated the important benefits of issuing bonds in tokenization format. We believe the potential can be further unlocked as the market develops. We hope our efforts can create demonstration effects and prompt market participations to start readying themselves to embrace the potential game-changing technology. Looking ahead, with mainland initiatives such as the further opening up of the onshore repo market, the launch of offshore treasury bond futures, and expansion of the collateral functions of onshore bonds in the offshore markets as the near-term goals, we are continuing our efforts in enhancing connectivities with the mainland and smoothening the cross-boundary flows of capital between mainland and international financial markets, with a view to shaping Hong Kong as a key and major international mainland capitals. Echoing what Darryl have said this morning in his keynote speech, we will continue to promote development of the green and sustainable financial markets in Hong Kong through different initiatives. In particular, the Green and Sustainable Finance Grant Scheme, which will be extended to 2027 and expand to cover transitional finance instruments. On the technology front, we will continue to promote innovation and the use of technology, such as tokenization, to drive further efficiency and transparency gains in the bond market. Together with other bond market initiatives, we are sure that Hong Kong's platform An ecosystem will continue and become even more attractive and conducive to market participants looking to seize new opportunities ahead. So this round up my presentation today. Thanks very much.
Thank you very much, Mr. Leong. And we at ICMA are certainly very honored. And actually, it's quite a lot of fun to cooperate with HKMA on our shared interests of improving innovation and increasing the efficiency and cross-border flow of investment into China. Really appreciate the role of HKMA in all of this and the continued partnership. So thank you very much. Now let's move on to our next keynote presentation, which is a presentation on Chinese repo market structure, dynamics, and opportunities. We'll be continuing many of the themes that have already been raised in the speakers that have spoken so far. Our distinguished guest today is Ms. Ting Zhang, Deputy General Manager, China Bond Collateral Management Service Center of CCDC. I will note that the presentation will be spoken in Chinese, so if you would like to have a live translation, please make use of the headsets just outside the door. The slides will be bilingual, however. Thank you so much.
Distinguished guests, good morning, everyone. I'm very glad to attend today's event. Please allow me to speak in Chinese next. Thank you. 各位来宾大家上午好，非常感谢 ICMA 的这个邀请，也非常荣幸参加我们今天的会议。我是中央结算公司担保品中心的张婷。前面的各位专家呢，都跟我们分享了亚洲债券市场的新的趋势和展望，我非常有感受。那么今天我想借此机会，我从基础设施的角度，从担保品管理机构的角度，也想跟大家分享一下中国债券市场的开放和担保品的跨境应用。首先我们的债券市场是中国金融市场非常重要的组成部分，也是扩大开放对外开放和这个开放的一个非常重要的一个主阵地。那么近年来，中国债券市场，刚才各位领导也都分享了，中国债券市场的开放得到越来越广泛的关注，对我们国际投资者的吸引力也在不断的增强。我们看到境外投资者的类型在不断的丰富，数量也是稳步的增加。截止到今年的2月底，共有1128家境外机构主体入市，那么涉及到70多个国家和地区。境外投资者持有我们银行间债券市场的债券是3.95万亿元，那么其中境外机构在中央结算公司托管的债券是3.21万元，那么占比超过80%。第二就是我们中国债券市场的国际影响力也是得到了显著的提升。我们看到从2018年开始，中国债券市场是先后被纳入3大国际债券指数，反映出了我们全球投资者对中国经济和金融开放的信心。那么第三呢，就是我们债券市场逐步从要素型开放转向制度型开放，那么各项规则制度也与国际接轨，跨境的投融资的便利度也在不断的提升。那么在开放的过程中，香港是非常重要的，我们的国际金融中心也在持续的不断的完善营商环境。那么从优化入市流程一直到入市后的服务，从2017年推出的债券通的入市机制，那么再到去年我们发布的互换通业务，一直到今年，刚才大家都在提到的就是跨境回购业务即将推出。那么通过境内和香港两地的连接，境外的投资者可以更加便利、更加深度的去参与我们的中国债券市场。此外呢，我们还观察到，那么债券市场的对外开放其实是需要我们金融基础设施的合作。金融基础设施的安排决定着我们的证券和资金的流动。那么通过基础设施的互联安排这样一个底层的架构， 可以稳妥有序的去衔接境内外不同市场的规则和实践，有效的去连通国内国际两个市场、两种金融资源。那么在中国人民行的指导下，中央结算公司作为中国债券市场的基础设施，我们一直也是在发挥着境内外市场桥梁纽带的作用。我们跟香港金管局、债券通公司也有紧密的合作，不断的去完善债券市场入市的渠道，创新我们更多的产品和服务机制。相信我们在各方的共同努力下，境外投资者参与中国债券市场的机制会越来越完善，那么参与的方式也会越来越灵活。那么第二，就是在跨境互联体系的搭建中，担保品管理的应用，可以有效的去促进境内外金融资源的循环和配置，是跨境金融体系的枢纽平台。那么金融基础设施其实在我们的服务中非常重要的一环就是担保品管理。那么跨境金融交易中也是发挥着这样的一个基础服务的功能，也是我们债市开放非常必不可少的一个环节。那么为了响应开放的要求和我们境外投资者的诉求，中央结算公司也是精心的打造着我们的担保品管理服务。那么现在呢，是构建了全球最大的债券担保品管理平台。我们现在的担保品的规模是超过28万亿人民币。那么连续7年也是获得了全球中央托管机构的首位。那么与此同时，其实我们非常欣喜的看到，近年来其实各国的监管部门也都越来越重视跨境担保品领域的合作与互动。那比如在欧盟它就颁布了中央证券存管机构条例，那这样的一个规则，就把欧盟的证券托管机构的互联互通，它制定了相应的标准和要求，为我们的担保品的这样的跨境的一个调拨提供了非常重要的一个基础。那么我们国家的中央银行也多次在多个场合提出，要推动境内债券成为全球广泛接受的合格担保品。像中国财政部也在中英和中德这样的一些高级别的对话中，也提出了要把中国的债券纳入全球合格担保品这样的一个范围。香港特区政府也提出了这样的一个说法，支持境内债券在香港成为合格担保品。所以可以看出跨境担保品的合作的重要性，现在已经提升到了国家和监管的这么一个高度。那么作为中国债券市场比较专业的一个担保品管理机构，我们一直在推动人民币债券成为国际市场的合格担保品。那么从国际实践来看呢，担保品应用的非常重要的一个领域就是我们的回购市场，这也是我们金融机构非常重要的流动性管理的一个场所。所以在23年的时候，我们和 SMA 就开始协作，共同启动了联合白皮书这样的一个项目。我们就是希望通过白皮书来共同研究人民币债券担保品参与全球回购交易的可行路径和业务框架。那么在这样的白皮书的编写过程中呢，我们非常直观的一个感受就是，全球回购交易中的合格担保品的种类是在不断的丰富。那么跨境交易、跨境担保品的流动也是日趋的频繁。投资者也是在呼吁要增加优质担保品的供给，同时也要提升担保品调拨的这样的一个便利性和效率。那么针对这一趋势呢，联合白皮书我们也全面的总结和分析了境内外回购市场的结构、制度、运营等关键要素。那么开创性的总结和分析了推动人民币债券成为全球回购市场合格担保品的关键的要素。那么系统性的探讨了人民币债券担保品参与全球回购交易的这样的一个可行性。那么整体而言，我们看到人民币债券目前从信用等级、高流动性、低通胀率和低汇率风险等方面，它其实已经展现出了 安全资产的特质。那么国际市场对人民币债券担保品的跨境应用都持有非常积极的一个态度。那么另外一方面呢，其实我们在白皮书里也提到了，我们还面临着诸多的挑战，比如境内外回购主协议的对接、终止净额结算机制的实施、违约处置资金的这样的一个安排，跨境互联体系的搭建等等。那么因此，我们的白皮书也是从短期、长期提出了针对性的意见，为全球投资者更好的去管理和应用人民币债券提供思考和借鉴。在去年10月，我们的联合白皮书的中文版是在中债担保品国际论坛正式对外发布，也受到了境内外市场广泛的关注和好评。那么今天，联合白皮书的英文版也正式将和大家见面。我们通过一段视频看一下，请看大屏幕。
Throughout history, the Silk Road has connected China and the rest of the world, witnessed and promoted vibrant achievements and mutual prosperity of global economy. Today, FMIs construct the Silk Road of financial markets, supporting a thriving global financial market. On a global scale, the increasing recognition of RMB assets by international institutions leads to rising demands for RMB bonds in offshore markets. The era of cross-border integration has arrived. To meet these demands, CCDC and ICMA jointly wrote a white paper exploring new channels for RMB bonds collateral to participate in global repo transactions. The white paper integrates the perspectives of a Chinese FMI and an international industry association. Through a comprehensive analysis of the repo market, it proposes a clear and feasible framework. In October 2023, the Chinese version of the white paper was officially released at CCDC Collateral Management International Forum, attracting attention from both domestic and international investors. Today, the English version of the white paper is released for the first time, offering new solutions for the cross-border use of RMB bonds. The future now arrives. CCDC will keep collaborating with market participants, bringing new opportunities for the cross-border use of RMB bonds and vitalizing international financial cooperation. Together, we will paint a beautiful picture of a globally interconnected financial system and make the financial Silk Road shine brightly.
好，谢谢，谢谢。香港是我们全球最主要的国际金融中心，也是我们这个亚洲最大的资产管理中心。那么今天呢，我们这个白皮书的英文版在这里发布，是非常有意义的。所以我们希望借助这样的一个平台，能够帮助全球投资者更好的去了解和参与中国债券市场，加强我们境内外市场的融合和互信。那中央结算公司也希望与各界市场同仁紧密合作，为全球投资者使用人民币债券提供专业高效的服务。那么最后，再次感谢香港金管局和 SMA 提供的这样一个平台，谢谢大家。
谢谢 Ms. Zhang. Thank you very much. And we're very grateful for the partnership that's current and ongoing with CCDC and the further opening up of the China repo market. Now, our final panel for the day, last but not least, we'll be speaking more about the China cross-border debt securities market, talking about infrastructure, opportunities, and the next steps for internationalization, going into more depth about some of the themes that have already been spoken about in the keynotes so far today. Our moderator is my colleague, Rico Zhang, Senior Director of ICMA, and our panelists are Candy Ho, Managing Director, Head of Business Development, Markets and Security Services for Asia Pacific for HSBC, James Sun, Head of Asia for TradeWeb, Minnie Siu, partner at King & Wood Mallisons, and Tony Wong, General Manager of Bond Connect. Once we have completed the setup on the stage, I would welcome the moderator and speakers for the final session. Thank you so much. Welcome, Rico.
Thank you, everyone, and thanks, Mushtaq, for the introduction. As you know, home to the second largest market in the world, significant steps have been taken to showcase China's economy, promote the internationalization of RMB, and facilitate global investor access to Chinese issuers. According to the analysis my colleagues just presented, the international bond issuance from Chinese issuers reached over 100 billion US in 2023, a slight decline from the previous year. However, decent bond issuance rebounded significantly from about 18 billion US in 2022 to US 34 billion in 2023. This is also encouraging development in China's penny bond market. According to data from the NAFMI, the penny bond issuance from foreign borrowers reached about 18 billion US dollars as of Q3 2023, exceeding the total annual issuance amount from 2022 at about US 11 billion. In today's panel, we will break down to the recent trends in the Chinese cross-border market by looking at their structure and the supporting regulations with our four distinguished panelists. So maybe I kick off with Candy. Can you give us a market update on the Chinese cross-border markets? What types of bonds are foreign investor buying?
Thanks, Rico. And first of all, thank you, ICMA and HKMA for inviting me to join this panel. And at this beautiful venue, looking, on the Hong Kong side, and I think Hong Kong has been playing a very important role in terms of cross-border development and the usage of RMB. And in particular, with the debt markets and the bond markets, we've heard already, the previous discussions with regards to the CIBM, the Bond Connect, and the recent development on Swap Connect, and repo, etc. I think the key here is to provide very comprehensive instruments, that instrument, derivative risk management instrument, to international investors, especially when they invest into the China bond market. I think everybody's quite aware that in the past 18 months, there's been quite a change in terms of the macro environment, the interest rate differentiation between the US, the Western market, and also the China markets have sparked a change in terms of the investor behavior. And also, despite the headwinds that we've seen, for example, in some of the credit market contractual, issue around the local government debt, etc., we've seen investors really focusing on the rates. The rates products. And if you think about the onshore market in particular, despite all the the noises around the slowdown in terms of the investment, but as you've just seen in the presentations, in fact, we've seen a significant pickup in terms of net foreign purchase of onshore bond last year in 2023. It's been significant pickup from the 2022, and it reached around 1.5 trillion RMB. So, and also we've seen foreign investors bond holding again has have picked up since mid of last year, and most of these investors, I would say this is a more so long term. real money investors who are looking for a long-term exposure in the China market. And the focus has been on the rate side. For example, CGB, MOF bonds, CDs, NCDs, and also sort of very high quality bonds. And with the introductions of the Swap Connect last year, and it's highly anticipated that the bond repo would also be launched, hopefully, soon, very soon this year. It provides a lot more risk management tool for investors to use to manage their risk exposure when holding China bond. And looking into Asia, in Hong Kong in particular, the offshore market, as Rico already pointed out, there has been a very, very strong demand on the dim sum market. We've seen a significant increase in terms of issuance. One thing that I would say is, the sort of key highlight is that we've seen a lot more diversified issuers in the dim sum bond markets. I would say in the past, it's mainly bank CDs, a lot of RMB CDs issued by the mainland banks. But last year, we've seen a very diverse in terms of issuance. We've had non-bank FIs. We've had foreign non-Chinese FI banks, especially, for example, some of the Middle Eastern banks have been issuing, RMB dim sum bonds. We've also have, for example, lately, some of the few onshore credit and also local Hong Kong credit corporate issuing the dim sum market. So I think, we've seen, the dim sum market developed in the past 5, 6, 7 years. But last year have seen a revive in the dim sum market with this variety of new issuers coming into the market. So it's very exciting. There are clearly challenges, but also there are opportunities we've seen, and investors are trying to grab those opportunities in the last year or so.
Thank you, Candy. I think this is consistent what I have heard when I accompanied my CEO, Brian, when we visited Beijing last week. The long-term investors would long their position and exposure to the RMB assets, particularly to the onshore market. And indeed, when compared with the stock market, the bond market actually still witnessed the net inflow in 2023. This is quite unusual, and this actually proved the attractiveness of the Chinese onshore bond market. Let me turn to Tony, if I may. We talking about how to access the onshore market. So how have the various connect schemes involved to this changing demand, and what is next for Bond Connect and your team?
Yeah, very good question. And first of all, thank you for inviting me to participate and review the history of the Connect scheme in the past several years. And as you know, that China bond market is second largest one in the world, and also it provides continuous sustainable return for international investors. For instance, according to Bloomberg Bloomberg Bond Index, the China Bond Index give a cumulative return of 36.6% since the inception of Bond Connect in July 2017. Even if you change it to US dollars and head back to US dollars, still give you a 28.6% cumulative return. In comparison, in the past 7 years, US Treasury just give a cumulative return of 2.8%, and the global index give a negative 13%. So as you can see, that the China bond market is really somewhere that investors can park their cash, large amount of cash, and also have a sustainable return. But barely the market is touched because the foreign holding ratio is just around 3.8%, something like that. So we need the market to be open for the international investors and also for our domestic investors. So as you can see that we have seen the challenges, which really comes from the difference between China bond market and international ones. It's so huge and so complicated and so different from the rest of the world. So the connect scheme is so challenging, something like you're connecting a cube with a globe perfectly. So the PBOC really just take the step-by-step approach by focusing on the real demands, real needs of international investors, and also adhering to the international practice. And they just release the market sectors one by one from the core to the relevant areas. As we can see that in year 2010, that China PBOC open market to clearing banks, foreign central banks, and also to multi supranationals. And in year 2016, we see that the market open to all types of foreign investors to invest in the bonds in China bond market directly, what we call the CIBM direct mode. 1 year later, we have the Bond Connect northbound. And literally, it is on this stage that HKMA announced the detailed settlement arrangements for Bond Connect on the 1st of July 2017. The first time that HKMA broke the rule to just make briefings to the AIs on the holiday. And now the trading volume for Bond Connect is already 10 trillion by the end of last year. So amazing growth. And in the same year that we also see PBOC and SAFE allow foreign investors to convert foreign currencies into onshore RMB through the FX settlement banks in Hong Kong to facilitate their investments and hedge their currency risk. And in September 2021, we see Bond Connect's southbound facilitating the onshore investors to broaden their investment channels internationally and have more asset allocations in Hong Kong and globally in the fixed income sectors. And last year, we see the announcement, the launch of Swap Connect, which is a very unique arrangement that's connecting two CCPs altogether and to build up the access to the onshore AIS market, helping the international investors to hedge their interest risk in their bond investments. And in January this year, HKMA and the PBOC announced 6 policies, including the Repo Connect, as we all know. And in February, the consultation is completed for Repo. So you can see that the involvement of the Connect scheme is so far we've seen the great achievements and everything seems so simple and easy. But now, at that moment, when we open a certain sectors, you can see it's a very challenging one. And really take these opportunities. I really thank all the participants, including the investors and the policymakers and other stakeholders, to devote heavily and commit to the development of this market. Yeah.
Yeah, thank you, Tony. I think it's always very exciting to see different Connect scheme. And I note this is actually the 10th anniversary of the Connect scheme. Obviously, the first one was the Stock Connect between the Shanghai and Hong Kong, but we are very excited to witness the historical moment about celebration of the Connect scheme, and we hope we can see more. As you mentioned, probably the Ripple Connect would be the next one, and this is another effort by the onshore regulators to showcase their willingness to open the market. So let me turn to Minnie. From a legal perspective, how have ongoing facilitative measures by onshore authorities affected the markets?
Thank you, Rico, and thanks to the organizers for this great event. Me as a lawyer, so I'll focus on the legal developments. Well, first of all, I think the biggest breakthrough, from a legal perspective, is definitely the recognition of close-out netting. Because I recall that 2018, I went to a similar event held in Shanghai, talking about the CIBM bond market and Ripple market. And back then, in my slides, I still recall that one of the biggest concerns from the international investors is recognition of close-out netting. And with the latest rollout of the futures and derivatives law, obviously we've resolved the close-out netting issues for OTC derivatives. And hence, I think that sets out a very good foundations to have the Swap Connect, because without that issues being resolved, I think there will still be international investors' concerns about that issue. So first of all, I think close-out netting for OTC derivatives is recognized by FDL. So obviously, the FDL by its title only applies to futures and derivatives. And hence, when it comes back to the Ripple market, the spot market, unfortunately, that falls out the scope of DL. However, I think the onshore regulators as well as market participants have pushed very hard to let our Chinese regulators be aware that close-out netting is so fundamental, important to the global financial transactions, in particularly in the Ripple market. And so I think, notwithstanding, the close-out netting, the Ripple market's scope is not exactly falling within the FDL. However, I think there are, previous regulatory, very, very positive statements set out in the notices issued by CBIRC at various public occasions about the enforceability of close-out netting in the context of financial transactions. So importantly, I think, financial transactions is not, from a PLC perspective, not just confined to derivatives. It also captures the typical CIBM bond market, the Ripple market. And so I think, Tony and other speakers have already mentioned about the January reforms announced by the PBOC and HKMA to further promote and open up the Ripple market. So I think one of the very interesting implications we can find in the Ripple notice consultation. It's still just to clarify that it's still in consultation process. So the final rules are not yet published. But we do notice that in that consultation paper, it specifically refers to potential recognition of other master agreement for use in the onshore Ripple transactions. So we all know that currently it's mandatory to use the onshore NAVME Ripple master agreement, but the indication there could be other master agreement to be recognized extremely encouraging. And I think that will also echo some of the previous CBIRC, now called NAFRA, that financial transactions should, when the close-out netting mechanism should be expressly recognized in that. Other than this, I think, people have been talking a lot about the Bond Connect and various Connect schemes. And I think it's worth highlighting that when PBOC announced the launch of Bond Connect back in 2017, it expressly mentioned that, beyond the cash bond transactions, other types of transactions such as bond Ripple, bond lending, interest rate swap, currency swap, forward, could potentially be gradually be rolled out as well, pursuant to similar infrastructure. So again, I think that is, like a positive statements that we look forward to having the actual implementation details to come out. Thank you.
Thank you, Minnie. I think that's a very good summary about the gradual step-by-step, the onshore regulators trying to open up the market, and this Ripple announcement by PBOC before the Chinese New Year. Actually, Minnie's team at the King of Medicine really helpful to put together the response for ICMA to really respond to the consultation about the proposed Ripple launch or precisely Ripple Connect. This also is close to ICMA's heart because, as you know, in China, we are very well known with our work in sustainable finance. but actually GEMRA, the Global Master Repo Agreement, actually is our baby. So we actually very well known in international market about our work in repo. And in fact, the event Minnie just mentioned in 2018 actually is CCDC's International Investor Forum, when we have such a comparison between the NAFI Master Agreement and the GEMRA, and underlying components to our white paper just released with CCDC, there's also a comparison between the two master agreements and the underlying difference between the two repo structure, onshore versus offshore. So you are very encouraged to give a read, and it's a very good analysis. Moving on, let me go to James. TradeWeb actually is the first channel to link the Bond Connect scheme. So how has technology underlying the Connect schemes evolved from an operational perspective?
Well, if I can quickly comment on a short conversation I had with Tony before the session. I think Tony told me that Bond Connect Northbound was announced here in this room. Yeah. Seriously. So so that's very interesting because when the Bond Connect scheme was in the concept stage, and when we were trying to bring this together, we weren't expecting this to be this significant. Okay, and it turned out that today it is very well structured. It's a systematic. A particular connect will resolve a particular element. It's becoming a main play, a key play. And Hong Kong being a key element of this, so this is wonderful. And a quick comment on the inflow from global money into China bonds. It's not a surprise. I came from the asset management side. It's a significant underallocation of RMB assets. If you compare that with the size of the Chinese economy. So the market demand will be there, and so what we do here have staying power. That's what a quick comment. On the electronification side of things, I think things are going there, right? I mean, we're living in the age of technology enhancement, big data and AI. So I think this is definitely where things are going. All the Connect programs, if you look at it, are electronic. China and Hong Kong have top-notch electronic infrastructure because it was built late and up to date. So it's fairly easy or relatively easy to plug in, technology, electronic trading, into those programs. The other element is, electronic trading is favored by regulators, both BOC, CFATS, and the global regulators. It's transparent. It leaves a trail. Yeah, and also it's fairly efficient, I should say. It reduced transaction cost, and those are the key KPIs for PBOC and CFATS. A European example is when when the asset managers responding to the best execution requirement, TradeWeb's RFQ model becomes very popular. So sometimes, the regulator can also drive industrial changes. So a quick comment on those.
Thank you, James. I think the new technology, how to apply these things to the bond space, and also from electronic to digital, that is a big topic in terms of from the fintech perspective, and ICMA again very involved and plugged into the space, help our members. and also the market to better equipped with the new technology. We discussed about the market structure and highlight some recent developments. Moving on to the regulation and the market practice. Let me go to Tony first, because Bond Connect obviously is very popular. The liquidity, everything, particularly in the northbound investment. Maybe you can share with us some new trends and have you seen different dynamics?
Yeah, since inception of the Bond Connect northbound launched, and we can see the liquidity really just being improved continuously. And also truly believe that the trend will continue. There are four basic reasons to drive the liquidity improvement. First of all, the policymakers, which is PBOC and the CFAS, the major infrastructure. When there is a new policy or new product to be launched, PBOC listen to the market and try all the best to make an adjustment to the current policy structures in order to strike a balance between market efficiency and the safety of the overall financial system. And the CFAS really just make the details of all the trading arrangements and to make things operated smoothly. And then they also invest enormously in the infrastructures. So basically, you can really have a very efficient trading platform, and also they really fit to any potential increase in the new products. Secondly, thanks to the contribution of the trading platforms such as James and all the others, Bloomberg and the Market Access, they all invest heavily to build up the interface for international investors to invest in the onshore markets. And also they build up technologies to streamline the whole process from the very beginning of the order placing to the end of the settlement, STP, APIs, whatever, to ensure the trades are really just done as efficient as what they've done in other countries. The third is the market makers onshore, in the onshore markets. The 60 market makers really should pay high attention to their international business development. So they actually allocate the best resources to the market making service to foreign investors. They use the best technology to provide competitive pricing. Some firms even set up special portfolios to handle the small tickets coming out of the asset managers index tracking and monthly adjustments. And that's all really just result in a very competitive pricing. The first one are really the diversified investor base. We can have the investors from different countries, from different types of industries. So when the market moves, there are always trades. So as you can see that the in terms of the trading tickets allocations in the past 5 years, 5 years ago, the ticket size larger than 100 million RMB and with the ticket size smaller than 10 million RMB accounts for about 25% of the total structure, and something between accounts for 50%. Nowadays, you can see larger tickets, middle tickets, and small tickets account for 1/3 each, which means that both large tickets and smaller tickets are carefully be taken care of. And then that investors really just can explore their trading strategies freely in this market. And looking forward, I still believe that the trend will continue because this is pretty special as we see that there are going to be repo connect to be implemented. From this year, we do not have to talk about that single product. The importance is more comprehensive, which means if the repo is implemented in this year, then we can see the four basic areas or the four basic elements of a bond market open up are completed, which means cash bonds, FX, and the hedging and the repo. With the four areas opened to the international investors, I think that the investors will have a more efficient way to implement their trading strategies or investment strategy and better tools, more tools to hedge their risk. So they will have more confidence to come to the market. And I truly believe that the market liquidity will increase. Not saying that maybe they can also enjoy the advantage of Hong Kong to use the CGB futures to be launched by Hong Kong Exchange. So looking forward, I have full confidence that the liquidity will improve and the markets will be larger for investors.
Thank you, Tony. I agree. It's very encouraging to have all those things in place and to allow international investors to take a full advantage out of it. James, I know you recently had some interesting meetings with the regulators onshore, and just to share with us your observation about the recent efforts by those authority bodies to make regulations closer to the market reality. And maybe you can share with us about your outcome of those meetings.
Thank you. We were actually in Beijing last week. And as you mentioned, the rulemaking is still a work in progress, so it makes sense for us to be there. I'm not sure how much details I want to share in the public setting on the specifics, but my general impression is from PBOC and NAFME perspectives, their effort and willingness to bring the rules closer to global standard is fairly real. It's a lot of work. And Tony mentioned that, it's very difficult because the two markets are developed separately and structured separately under different rules. And certain market norms and practices are developed for that individual markets, that unique market, and for good reasons. And it makes sense for the local market. So how to bring the two elements together? I think you need willingness from both parties in order to deal with this difficult task. On the China side, they definitely welcome international participation to the marketplace. So they will accommodate and they will make rules easier for global participation. On the global side, this is a huge market and you want to come in and you want to operate. So the decision will be, would you like to adapt to a little bit of the market reality there? But I think as long as willingness are there on the both sides, things will get easier. I have to give credit to ICMA and NAFME. It's a lot of detailed works. I certainly appreciate the complexity of things, and also for the industry to give feedback. And as I can see, some of the feedback has been responded to, which is a good sign.
Thank you. Particularly thank you for the acknowledgement of our work. And actually, we work very hard with our counterparties in China to facilitate the market and encourage more development in the bond space. Talking about the regulation, let me go to Minnie. In terms of the regulatory and infrastructure developments for the China cross-border bond market, we're talking about Ripple, etc. So maybe you can share with us what's next we should expect.
Well, actually, I think when PBOC and SAFE came out with the consultation paper for the expansion of CIBN bond Ripple market, we were only speculating then that, it seems like there is a suggestion for expansion of Bond Connect to cover the Ripple Connect. And it's so great to hear from Tony. I think it seems like that will be the direction, and timing may be, hopefully, within this year. Or around that time zone. So first of all, I think definitely the Ripple Connect, because we all know that currently, even with the expansion of foreign investors' access to the onshore Ripple market, only those CIBM directs and QFIs, they have onshore accounts. So, for the expansion to allow Bond Connect investors to access the onshore Ripple market, there is this hurdle, operational hurdle, that typically they don't have the onshore cash and settlement account. So having this new infrastructure linking, allowing the Bond Connect investors to be able to trade in the Ripple market through their offshore setup, I think that is extremely important. So I think we all look forward to the rollout of Ripple Connect in some form, perhaps riding on or leveraging off the Bond Connect, Swap Connect experience. And secondly, I think it was not widely mentioned about the bond lending market in China, because actually back in 2022, NAFMI published a new version of the onshore bond lending agreement template. Again, I think similar to the latest Ripple consultation paper, there was a very prominent policy objective to converge the onshore market with international standard international market. And so I think, again, hopefully with the expansion, relaxation on the Ripple, markets of foreign access, we will expect to see the adoption of more the internationally like a familiar mechanism of outright transfer, because we all know that currently in China, onshore Ripple market, predominantly they are done by way of the pledge Ripple. So that apparently had a huge impact on the liquidity of the bonds being locked up. So if we could have international investors having the flexibility to use globally recognized master agreements such as Streamwa, which adopts the outright transfer mechanism, we hope that will greatly facilitate the convergence of the onshore Ripple market with the international expectation. So I think that will be the two look forward statements that we hope to see soon as within this year.
We certainly hope so as well, and to more people to use Jimra, and also look forward to the launch of the Ripple Connect as early as probably the Bond Connect anniversary in July. That's the hope. Moving a little bit from the Ripple and also the market access to the onshore, as Candy mentioned, the booming of the deepen bond market, and also, as I said, even the pendant bond, basically the RMB denominated bonds actually in 2023, very, very good. So how has issuer appetite evolved given this onshore policies stance? And maybe Candy can share with us from the primary market perspective.
Yeah, sure. I think especially if you talk about the offshore market, right? As I mentioned in my earlier discussions, we've seen a much more sort of diversified issuers coming into the offshore market. Why? It's not just about the the interest rate, because if you are an onshore investor, you can actually get much cheaper funding onshore in RMB. Why do they want to come to Hong Kong in the dim sum market? Partly because Hong Kong is international financial market. It attracts a lot of international investors to look for diversification in terms of accessing or buying China credits. And if you think about the RMB bond market and the traditional sort of dollar credits, in fact, I think the RMB market last year, in terms of total issuance, have exceeded the Chinese dollar credit issuance. So we've seen a lot of investors looking for exposure in China/RMB. They don't have much choices in the dollar market, so they look for opportunities in the RMB market, and hence, we see a lot of the onshore Chinese non-bank investors, non-bank issuers would also like to come to Hong Kong to access these international investors. And again, similarly, we've also seen a lot of non-Chinese or non-Greater China issuer coming to Hong Kong to issue in the dim sum market, partly to also try to attract onshore investors through the southbound Bond Connect scheme as well. So, we've seen the dynamic have changed in the offshore market, all thanks to, the policy opening up in terms of more encouraging onshore issuance in Hong Kong, as well as the, openness of the Hong Kong market. I guess one last point I want to mention about onshore in particular. This year, something that we watch out very, very closely is about the implementations of the Basel III. So something that I guess people might already been quite made aware of, the implementation or adoptions of the Basel III onshore. The regulators have already made it effective on the 1st of January 2024. So we would expect a wave of TLAC being issued in the onshore market. And TLAC is something that it's quite familiar with the international investors, but less so, I guess less so in the sense of issuance in the onshore market. So this might be a good opportunity for international investors to participate in the onshore TLAC through either the Bond Connect or CIBM as well. So it's something that we closely watch out for.
And that's good for the RMB internationalization. Okay, so we previously discussed a lot about this potential about Bond Connect and also the Ripple in particular. And let's look into details about cross-border ripples and particularly the benefits. And I'm conscious about time, and maybe just we make sure that maybe just to make our remarks relatively shorter. Candy, let me come to you again. The onshore ripple markets has grown quite significantly over the years. So maybe you can share with us about the sort of like a new trends you have witnessed.
I'll be quick. As you said, the onshore ripple market is a very, very large market. It's the daily turnover is 7 to 8 trillion RMB. The launch or potential launch of the Bond Connect, Ripple Connect, and also, the banks have already been able to access the onshore repo via the CIBM Direct. This will allow the offshore investors not just to hedge the interest rate risk. Of course, they can use the repo to hedge the interest rate risk, but also allow the banks in Hong Kong to access the onshore liquidity, which would help, to build up the offshore liquidity through the repo. And also, one key important thing is that, you would encourage investors to hold more CGB, because they can then use the repo to fund their investment. So 2 points. One, repo market offshore assets of repo market would help interest rate risk management. And secondly, would potentially help the offshore access in terms of the onshore liquidities in RMB.
Thank you, Candy. James, when you discuss with those investors and your clients, when they think about tapping the Ripple onshore market, some of them may have concerns. Maybe you can quickly share with us about those concerns.
I have a list. It's a long list, but in the interest of time, I'll focus on the top 3. Well, if you look at it, actually, some of them are being worked on, and some of them can almost be crossed out. The first one is support closeout netting. Apparently, it's important. I should say it's still challenging in practice, but the journey has begun, I think. Support the general agreement. And the impression, again, I had, in Beijing is, the Beijing side is working very hard to accommodate, both master agreements. So I think we can be hopeful of that. And you also mentioned a little bit of it. Support both pledge and title transfer. The idea is to let the market participants decide which type of repo works for them. And on the China side, I should encourage a new form of repo to be introduced. Why not? It may work. Of course, you're going to attract global participation. And if you can say one more, maybe a bit, sort of tricky is the attention to potential settlement failure, which is not tolerated in China for now, but which is fairly common on the global side of things, and there are things to be worked out. I think a process needs to be worked out.
That's a very precise sort of like points we are working on at ICMA. But I note that the first one and the third one actually contradict with each other, because if a pledge repo, there's no netting. So we obviously encourage more title transfer. And at the fourth point, actually, this is very important, because at ICMA, we have the buying rules to deal with those trading failure. And this is only accessible by our members. In case you're not ICMA members, you don't have access. Sorry about that. But I encourage you to consider that. That's interesting about this like laundry list that we want to achieve, and also the GMRA, more use of GMRA title transfer, close-out netting. These are all very close to our heart in the repo space. So Minnie actually best positioned to comment on this, because she helped us put together such a response to the PBOC consultation. Maybe you give us very quickly high-level summary about the consultation and our response.
Well, first of all, I think the overall is overriding positive market response to the latest repo relaxation rules proposal. So overriding positive response. And secondly, I think it's in particularly the biggest sort of relaxation that attracts market's attention is definitely opening up the market to all offshore institution investors who are currently engaging in the cash bond market. That incredibly extend the sort of the number and the scale of foreign investors' access to repo, which is currently we are only limited to sovereign entities, RMB clearing participating banks are very, very limited. So I think the expansion of the scale of investors is definitely a breakthrough. And secondly, I think, James, you also talk about use of outright transfer type repo that we normally use in the global market. I think it's encouraging to see that the repo proposal consultation paper expressly recognized the use of either pledge or outright transfer. Importantly, there are specific articles referring to the need of investors to, first of all, use a master agreement, and secondly, requiring the relevant master agreement template, the standard form, to be filed with PBOC. So I think both of these points indicate that PBOC will recognize and allow investors to have flexibility of use of other master agreement beyond the current mandated requirement for only the onshore NAVME. I think one other, there's a few submission points covered in their SIFMA and also ICMA submission. One is, again, although we have a very positive legal analysis to support close-out netting in the context of a GMRA, but it will be really nice to remove one more reserved concern of GMRA not being mentioned expressly in the PLC regulations or other notices. So this is, I think, quite a big point that market is asking for. And also, again, is to reconfirm the close-out netting enforceability, hopefully in this very, very ideal location, to have it stated, expressly stated in this upcoming notice to be published. And also, there's certain references to the offshore financial market infrastructure and self-regulatory organization to be subject to PBOC regulation. I think it's quite important that we need to draw a distinction between offshore financial market infrastructure, who provide the actual operational framework to investors, versus organizations such as ICMA, because ICMA is an organization involving voluntary membership. We don't mandate members to undertake specific actions, but it's a very important organizations to facilitate members to have a unified industry standard documentation. So I think these are the key points that we invite the PBOC to consider further, hopefully with clarification notes in the published version. And also there are some miscellaneous asks, which we think that not necessarily directly related to Ripple, but overall, how could a tax regime in China facilitate foreign investors access when it comes to assessment about withholding tax, capital gain tax? Because with other connect schemes and also market access schemes, the tax issue has always been potential hurdles for foreign investors to overcome, to understand. So I think that's also some of the like ancillary issues that we seek. We invite the onshore regulator to give further thoughts in the future in the rollout of the relaxation scheme. Yeah, so that's all from me.
Yeah, thank you, Minnie. That's a very good summary. And also, honestly, speaking from ICMA perspective, we struggling a little bit about being regulated by PBOC and the master agreement filing requirements. I know the HKMA colleague is still in the room, hopefully to leverage your resource. PBOC can listen to us and also the feedback from the market. So Tony, last but not least, the final question, very quick, when we can see the Ripple Connect happening?
Actually, the consultation is completed. So next step is to addressing those concerns and to make the detailed trading and settlement arrangements and the test of the systems and to be launched. We're on the same page. I don't know the exact date, but I hope it can be implemented as soon as possible. Yeah.
Thank you. Thank you. I think that's good enough for the time being. Again, I'm still conscious about time and it's time to wrap up, but I enjoying the conversation very much. I'm sure your audience share the same feeling as mine. I think this discussion can be just going on. It's a lot of technical issues within the space, but we all look forward to the development on the next sort of like a stage and really just to elaborate more work, with ICMA and also with the regulator, different stakeholders to open up the Chinese market and just to attract more foreign investments. Again, thank you very much for, if you can join me, give a big hand to my panelists and thank you for your listening.